The Ways and Means Committee will come to order. Let me say good morning and welcome all as we discuss what we would term the disappearing corporate income tax. It's been 2 years since the minority passed their tax bill without a single Democratic vote. The Republican law further concentrated wealth in America. The benefits clearly went to people at the very top. A reminder that since 2001, there have been almost $5 trillion worth of tax cuts. We continue to believe that it was irresponsible, costing $2.3 trillion alone and resulting in deficits as far as the eye can see. It was unfair, again, in terms of further concentrating wealth in the hands of those who were already doing very well. Its passage was marked by a string of fractured promises. It has failed to unleash economic growth that the President at one time promised to be up to 6%, nor did it raise families' annual incomes by $4,000, nor did it pay for itself. Just yesterday, the administration released their proposed budget. The President might promise to deliver economic protection to hardworking Americans, but the budget itself reflects very different priorities. Make no mistake about it, the effort will be made to double down on cuts to Social Security and Medicare and on further tax cuts for those, again, who don't need them, the wealthiest Americans, without fixing many of the choices that were made in 2017. We are here today to examine what's left of the corporate income tax. As our witnesses will explain, the corporate income tax falls far short of what our country needs. The corporate tax rate in the Republican law ultimately landed at 21%, giving many corporations a windfall that was compared to the 25% rate initially proposed by committee Republicans and 28% proposed by the Obama administration. 20 years ago, there was a budget surplus. Corporate tax revenues were twice as high as they are today. Now corporations are paying less than ever, and corporate tax revenues are at their lowest level in history outside of a major recession. Some large corporations pay zero year after year. It is therefore not surprising that we collect less corporate tax revenue than all but one of the other OECD nations. Particularly, the tax benefits reaped by large companies are not trickling down to workers. The White House promised American workers would receive $4,000 more in their paychecks. This certainly has not happened. Instead, what we have seen is over $1 trillion in stock buybacks, again enriching the already strong. Workers continue to wait for what they were promised. The law was moved through Congress in 51 days, much of it in the end interpreted by regulation. And unfortunately, Treasury gave away the store by issuing some regulations that gave even more tax breaks to corporations and that are likely to further the deficit. To make matters more complicated, because of extensive budget cuts, the IRS cannot even ensure that corporations are paying the little that they now owe. Audit rates for some of the largest corporations are lower than audit rates for low-income taxpayers, including those receiving refundable tax credits like the Earned Income Tax Credit. This is unacceptable, and it does great harm to our tax system. Corporations should pay their fair share of tax just like everyday Americans do. Soon, more than 150 million Americans will file and pay their taxes as they're owed. They will wonder why their partners in big corporations are not asked to do quite the same. I hope committee members can work together on real tax reform that will give a fair shake to all Americans. And with that, let me recognize the ranking member, Mr. Brady, for an opening statement.
Thank you, Chairman Neal. Regretfully, the whole premise of this hearing is false. Corporate taxes aren't disappearing, they're growing more than 12% last year, and according to the Congressional Budget Office, corporate revenues are set to rise over the next decade, both in real dollars and as a percent of GDP. To claim that corporations shoulder a smaller burden in the U.S. than in other countries is also misleading, because most U.S. businesses, 95%, files individuals or pass-throughs that aren't traditional corporations. The wild claim by Vice President Biden and others that all the tax cuts went to folks at the top and corporations that pay no taxes was dismissed as false by factcheck.org. Failed presidential candidate Beto O'Rourke claimed the GOP tax cuts were a $2 trillion tax cut that favored corporations. The Washington Post slammed that as not correct. noting that 3 out of every $4 out of the Republican tax cut went to individuals and small businesses. Of course, the oft-repeated claim by Senator Bernie Sanders that, quote, in the Republican tax bill, 83% of the benefits went to the top 1% were described as misleading by PolitiFact. Incredibly, some Democrats try to claim responsibility for the remarkable economic boom under President Trump, insisting this is a result of a successful Obama economy. But to use President Obama's own words, you didn't build this, because job growth is 3.2 million greater than projected, and the GDP is $266 billion larger than projected before the GOP tax reform. President Obama inherited a tough economy, no question, but the Obama economic recovery was the slowest on record. Paychecks were flat, jobs in headquarters flowed overseas, consumer confidence was down, small business optimism was non-existent, while food stamp and disability rolls exploded. Remember the summer of recovery, the vaunted stimulus? Well, neither do economists, because they failed to jumpstart America's economy due to a regulatory onslaught that choked our economy, especially for blue-collar workers. In inversions, companies leaving America seemed like a monthly occurrence. Thanks to a unified Republican Congress and President Trump, we rewrote America's outdated, uncompetitive tax code for the first time in 30 years. We created a tax code built for growth of jobs, paychecks, and the American economy. We let working families keep more of their money, doubled the standard deduction, increased the child tax credit, and expanded it to millions of more families. We created a first-ever small business deduction to help Main Street businesses thrive. We lowered the corporate tax rate from among the highest for our competitors to a more competitive 21%. We redesigned the code so our businesses could compete and win anywhere in the world, especially here at home. As a result, we have more people working and higher wages in one of the most competitive economies on the planet. American manufacturing is back, and workers who were left behind in the Obama economy are coming off the sidelines into good-paying jobs. Women, and especially women of color, are winning the jobs race for the first time in memory. Economic deniers refuse to accept these real results for working families, especially the poor and minorities left behind by the Obama administration. In a newfound love for fiscal responsibility, they'll recycle these tired lines like Republicans run up the deficit with tax cuts so they can cut Medicare and Social Security later. And quote, all the tax cuts went to stock buybacks. But with record and near record revenues flowing into Washington, as factcheck.org reminded Mayor Pete when he claimed the tax cuts were driving the nation's debt, CBO confirms that spending is largely responsible for the nation's debt. What's wrong with companies bringing back profits from overseas and investing in their own company, raising stock prices and improving the 401ks of their workers and retirement plans across America who have invested in them? Our economy, as I've noted, has created 3.2 million more jobs than projected before tax reform, with nearly 1 million more job openings than available workers. And income inequality is declining in all measures for the first time in decades, according to the current population survey. Wages are up last year 5.2% for workers in the bottom tenth of income versus a mere 1.9% for the upper 10%. In real life, that means $3,550 more a year for low-income workers. Wages are up more for ordinary workers than supervisors, more for African Americans than Caucasians, and more for bachelor's than advanced degree holders. And according to the CEA, since 2016, wealth for the bottom half is up a whopping 47%, while the top 1% a mere 13%. But it's impossible to get our debt under control when House Democrats refuse to even put a budget forward. Rather than vilify American businesses for political gain, Republicans are eager to build on the success that working families in America are finally seeing after years of disappointment and struggle under Democrats in the White House. And today could be an opportunity to debate the best ways how. The key to permanently increasing our revenues through making the tax cuts permanent, which will create 1.5 million new jobs and lock in gains for working families. We need to sell more Made in America products around the world through increased trade, and Main Street businesses everywhere are desperate for more workers. Those are the challenges this committee should be focused on today. I yield back.
Thank the ranking member. I want to welcome all of our witnesses. Each of your statements will be made part of the record in its entirety. I ask that you summarize your testimony in 5 minutes or less. And to help you with that time, there is a timing light at your table. When you have 1 minute left, the light will switch from green to yellow, and then finally to red when 5 minutes are up. Let me first introduce Dr. Furman, and we will hear from our next witness, Rebecca Kaiser. Chin-Ching Wong is the Senior Director for Economic Policy at the Center on Budget and Policy Priorities. Mr. Douglas Holtz-Eakin, like Mr. Furman, has been a frequent guest of the committee as a witness here, and he's president of the American Action Forum. And Dr. Furman, as you know, is a member of the policy team at the Harvard Kennedy School. Rebecca Kaiser is a professor at Fordham University School of Law, and her recent scholarship examines tax treaties, the tax legislative process, as well as the 2017 law. With that, let me recognize Dr. Furman.
Thank you so much, Chairman Neal. Good to see you, Ranking Member Brady, members of the committee. I want to make 4 points in my comments today, and there's some slides to go along with them. I'm not sure. Oh, that makes the first one appear. The first point is that corporate revenue collections are very low in historical perspective and compared to other countries. Last year, they were 1.1% of GDP. CBO projects they're going to rise very slightly to 1.3% of GDP, and if you extend a number of provisions, they wouldn't even rise as a share of GDP at all. Compared to other countries, the United States is about 1/3 the average for the OECD. It's higher only than the country of Latvia. These numbers aren't exactly comparable, as the ranking member said, because of pass-through taxation, both here and to some degree in other countries. Comparable data aren't available, but if you do adjust, you would still see the United States well below the OECD average, even including pass-throughs. My second point is that this low revenue level is very much a consequence of the law that was passed. The Congressional Budget Office, the Joint Committee on Taxation originally estimated the cost of the law at $1.5 trillion, or $1.1 trillion after macroeconomic feedback. Since then, the Congressional Budget Office has twice raised its estimate of the cost of the law, and so now it stands at about $2 trillion without macroeconomic feedback, $1.5 trillion with macroeconomic feedback. That's over the original budget window. The cost would be higher over the current budget window. The cost would be even higher by more than $1 trillion if all of the provisions in the law were extended and made permanent. It would take an implausible amount of growth to make up for this cost. And in fact, if anything, the data we've seen since the passage of the law is revenues have come in below what the Congressional Budget Office expected, suggesting that if anything, these estimates would underestimate the cost of the law after taking into account the economic impact, not overestimate the impact on the law. My third point is what we can learn from the macroeconomic data in the 2 years since the law was passed. A lot of caveats around this, a lot of uncertainty, a lot of different effects going on in the economy at the same time. In my written testimony, I go over those in great detail and would be happy to follow up on them. But want to show you this picture. If you found an economist that had been living in a cave for the last 3 years and had no idea what laws this Congress had passed and this president had signed, and all you did was give them the GDP data, they would probably have no idea that a corporate tax cut was passed. GDP growth is 2.4% in the 2 years before the law, 2.4% in the 2 years after the law. Consumption growth slowed a tiny bit. Business fixed investment growth slowed a decent amount in the 2 years since the law compared to the 2 years before the law. Residential investment went negative. That economist who had been living in a cave, who was looking at the macroeconomic data, would realize and expect that Congress had passed a law that created a short-run macroeconomic stimulus for the economy, which was an increase in government spending. That's the one category of domestic GDP that's gone up over the last 2 years at a faster pace than it went up in the 2 years before then. In fact, quite strikingly, if you look at every year since the economic recovery began, federal spending in this case was down almost every year from 2011 through 2014. It's grown, and it's grown at an increasingly rapid rate in recent years. That's given a temporary stimulus to the economy and helped economic growth. helped economic growth, which was facing a headwind from the fact that business fixed investment, excluding the volatile oil and mining category, was the lowest it's been of any year since the economic recovery began. And that's excluding oil and mining investment. If you had included oil and mining investment, business fixed investment in 2019, over the 4 quarters of it, would actually have been negative. So you don't see it in the investment data. What you do see is a fiscal stimulus that temporarily props up economic growth. My 4th point is that I don't think this Congress should return to the corporate tax law that was present in 2017. I think it should move forward, and I outline an approach where you could improve the tax base by making expensing permanent, disallowing interest deductions, and expanding the R&E credit, raising the corporate tax rate to 2.8%, and the combination of those changes would increase economic growth, would raise wages and incomes for the middle class, and would raise trillions of dollars of additional revenue. Thank you.
Thank you, Dr. Furman. Ms. Kaiser is recognized.
Thank you for inviting me to testify on the disappearing corporate income tax, and in particular on issues surrounding the regulatory implementation of TCJA. TCJA made the most significant changes to the tax code since 1986, and experts will endeavor to understand its effects for years to come. 2 concerning aspects of it have already emerged, however, which I'll discuss here. First, TCJA has failed to live up to its promise of broadening the tax base on foreign income of multinational corporations, which was the quid pro quo for a lower corporate tax rate. The design of the minimum tax largely preserves incentives to shift profits offshore. That the base broadening provisions did not alter the status quo.
Would you pull the microphone forward to you? Thank you.
With regard to profit shifting, makes for a costly trade with the new 21% corporate tax rate, which loses significant revenue. The second point is the focus of my comments here. Treasury has weakened these already generous features of TCJA in the face of intense lobbying for business interest, which will further erode the U.S. tax base. Troublingly, many of these regulatory giveaways have no statutory basis. In order to protect the administrative state against democratic deficiencies, administrative law mandates that an agency must provide notice of proposed regulations and grant the public an opportunity to comment on them, yet nothing prevents sophisticated actors from rushing directly to agency officials and hoping of catching their ear prior to this notice and comment period. These pre-notice communications, which are not transparent to the public, benefit from first-mover advantage. If a special interest can influence Treasury towards a favorable interpretation initially, it is likely that interpretation carries over into the final regulations. Before the ink was dry on TCJA, business actors and representatives swarmed Treasury to advocate for their interest. Treasury officials reportedly met with lobbyists for companies and interest roughly 10 times a week. At crucial turns, Treasury acquiesced to their demands, sometimes in contravention of clear statutory language. Notable examples of this can be found throughout the regulations. These first-mover advantages compound the greater participation that sophisticated parties already have in the formal notice and comment period, which in the tax context, industry actors tend to dominate. This is because they have the resources to deploy and because they stand to gain more from a favorable interpretation than any particular member of the public stands to lose from it. Furthermore, members of the public who are disadvantaged by Treasury giveaways to sophisticated taxpayers do not have standing to challenge such giveaways under current law. Tax practitioners and bar associations are further constrained by client interest from making anti-taxpayer comments. These resource and incentive differentials generally result in little publicly interested comment in the regulatory process. In my written testimony, I examined the statutory basis for several Treasury regulations that were issued in the context of the new international regime, the new pass-through deduction, and the opportunity zone incentives. In several instances, I found no statutory basis for the positions reached by Treasury. Treasury, for instance, exceeded its authority in issuing the high tax exception to the minimum tax regime. This incentivizes multinational corporations to engage in more profit shifting than exists under the statute. Treasury exceeded its authority in carving out certain foreign banks from the new base erosion and anti-abuse tax in response to lobbying from banks like Credit Suisse and Barclays. Treasury's position allows these entities to erode the U.S. tax base by making deductible payments to related parties. In later communications, as Treasury spokesperson would defend the bank carve-out, stating that we were responsive to job creators. This statement does not obviate Treasury's duty to abide by the law, and instead indicates that the notice and comment process is in fact being dominated by special interests who are undermining the rule of law. Officials at the JCT reportedly put the revenue loss of exempting international banks at up to $50 billion, which is nearly a third of the BEAT's projected revenue collection. UBS, which lobbied for the regulatory changes, reported in its public filings that it expected to owe no BEAT liability due to regulations that, quote, were considered helpful to foreign banks. These patterns continue in the 199 Cap A and Opportunity Zone regulations. In the former, Treasury exceeded its authority in allowing high-income service providers a deduction for which they should not have been eligible under the statute. In the Opportunity Zone regulations, Treasury exceeded its authority in relaxing, sometimes completely lifting, the requirements to substantially improve property in the economically distressed areas. There are several ways Congress could respond to these dynamics, which I'm happy to elaborate on in the question period. I'll conclude by saying generally that Congress should aim to improve democratic deficits in the regulatory process, which have been on stark display in the TCJA regs. Since the birth of the nation, taxation and democracy have been closely intertwined. Congress must exercise its oversight authority to ensure that agency actions do not sever that connection. The integrity of the tax system and the rule of law are at stake. I urge Congress to give Treasury the tools it needs to weigh the public interest against private ones. Thank you.
Thank you. Let me recognize Ms. Wong.
Chairman Neal, Ranking Member Brady, and distinguished members of the committee, thank you for the opportunity to testify today. Deep cuts to Internal Revenue Service enforcement funding makes life easier for tax avoiders and evaders, including certain large businesses and corporations. These cuts hurt honest taxpayers and small businesses, even as they add to budget deficits. Thankfully, there's bipartisan recognition, including in the President's budget just yesterday, that lawmakers should restore IRS enforcement funding to protect the integrity of the tax system and to give honest filers the help that they need to prepare their taxes. It's a basic function of government to collect taxes owed under law, but over the last decade it's been severely depleted. IRS funding overall, adjusted for inflation, has been cut by more than a fifth. The enforcement budget even more deeply, by about a quarter. Enforcement staff, deeper still, by more than a third. And we've lost more than a third of revenue agents who are experted enough to audit the most complex returns. And that's why the largest corporations have seen their audit rates cut in half, and millionaires have seen their audit rates fall by more than 60%. Audit rates for low and moderate income people have also fallen, but much less sharply than for corporations and wealthy filers. And that's simply because their simpler returns are cheaper and easier for the IRS to audit, and so have been affected less by the loss of expert IRS staff. So now we find ourselves with working families who claim the Earned Income Tax Credit being audited at about the same rate as the highest income 1% of filers. Now that top 1% are responsible for up to about 70% of the tax gap of $400 billion of taxes owed but not paid on time each year. Overpayments in the EITC are a tiny fraction of that, but EITC audits are now 40% of all audits. The 2017 tax law adds to that inequity. Not only do the bulk of its business and corporate tax cuts flow to the wealthy, they also create job security for tax lawyers and accountants. And that's because they opened up big new gaps between the tax rates on different types of income. That's an invitation to shelter income where it will get the lowest rate. And as they do so, those tax advisors will push the boundary of the law between lawful tax avoidance and unlawful tax evasion in the face of an IRS that's under-resourced to try to defend that boundary. In last year's budget at least, IRS enforcement stopped going backwards. But overall, the funding for the IRS didn't keep pace with inflation, and the increase in real terms for the enforcement budget was less than 1%. Looking forward, there are three critical ingredients needed to rebuild IRS enforcement funding. First, we need to restore it. and that means a minimal initial goal would be to take it back to real 2010 levels. Second, there needs to be a multi-year commitment to doing so. That will allow the IRS to plan, to hire and train staff gradually. It's so depleted right now that it will take it time to bring on more staff and to train them up. Third, we need to treat IRS funding as the special type of funding that it is because it generates savings. Each dollar of IRS enforcement funding pays for itself many times over. And that means Congress can use special budget mechanisms to recognize that and ensure that it doesn't have to compete with other critical priorities for funding. There's a bipartisan foundation to move forward on those three key ingredients, including in the Trump administration's budget yesterday. It had a proposal, not perfect, but it would boost IRS enforcement funding by $15 billion over 10 years through a special budget mechanism with a gradual ramp up. Finally, I'd like to comment on priorities and inequity. Together, the 2017 tax law, many of its regulations, and IRS enforcement cuts have delivered deep-cut tax cuts to the wealthiest and large corporations, including tax avoiders and evaders. As the chairman mentioned, that's a bad deal for most Americans. Going forward, true tax reform should raise revenue and strengthen the integrity of the tax code, and it should directly boost incomes for workers and families by enacting proposals to strengthen the Earned Income Tax Credit and Child Tax Credit that Chairman Neal and many other distinguished committee members have supported. Thank you for inviting me to testify, and I welcome your questions.
Thank you. Mr. Holtz-Eakin.
Thank you, Chairman Neal, Ranking Member Brady, and members of the committee. It's a privilege to be here today, and I thank you. I'll make a few points, and then I look forward to answering your questions. The thing I'd begin with emphasizing is that prior to the passage of the Tax Cuts and Jobs Act, there was a bipartisan consensus that the corporation income tax had to be reformed. There was work done in the Senate Finance Committee, including bipartisan work on international tax reform by Senator Portman, Senator Schumer. There were proposals from the Obama White House. This committee had numerous attempts under Chairman Dave Camp to reform the tax code. And it wasn't surprising that this consensus existed. The combination of the highest statutory rate in the developed world and a worldwide tax base had led U.S. corporations to become tax uncompetitive when competing in third countries. It had generated a situation where repatriating funds was not incentivized, and large amounts of U.S. earnings were trapped offshore. And most visibly, it was the case that whenever there was a cross-border merger or acquisition, it was inevitable that the headquarters would leave the United States. And indeed, that's why the iconic symbol of American capitalism, the New York Stock Exchange, has its headquarters in the Netherlands. It's for tax purposes. That had to change. The Tax Cuts and Jobs Act reforms undertook to do that, move the U.S. toward a territorial system, got its tax rate down into a competitive place in the world, and took on these continued losses of headquarters, which I would point out would also lead to losses of employment, profits and income, and diminished corporate receipts. So the question really was, did we want to deal with the underlying economics in tax reform or not? This reform did do that, and I think the early evidence is quite promising. Inversions have stopped. We have not lost a headquarters since January of 2018, one that was already underway prior to the passage of the act. We have ended this painful exercise, which this committee went through every year, of trying to understand why iconic companies in the United States were moving elsewhere. In the aftermath of the passage of the act, we saw $1.1 trillion of funds repatriated to the United States. It continues to be above the historic levels. That's an important test of the law. Under the Tax Cuts and Jobs Act, there was a deemed repatriation. The minute it was signed into law, all overseas funds were deemed to have come back to the United States. So firms had to make a decision with no tax consequence. Do we bring the money to the U.S. or do we leave it overseas? The vast amounts flowing in are evidence that this is a better place to do business than it was before, and that's one of the most significant pieces of early evidence in favor of the act. We saw business investment rise from a low of essentially zero in the second quarter of 2016. That's the recent low. Business fixed investment reached over 6% in the middle of 2018. It has since tapered off, but the cumulative investment is well above what CBO had projected prior to the law. And I think, we have dealt with the fallout of a trade war, which has diminished the appetite for business fixed investment in the United States. But I think the contribution to the Tax Cuts and Jobs Act was quite significant and very, very important. And I would encourage the committee to take Jason Furman's advice and move forward, not back. The tax code we had was unacceptable. This one is more competitive and can be improved. There's no question about that, and that would be the route to go. Let me just say briefly that I, at least in my observation, think that the process that surrounded the implementation of the act, the rulemaking, is more ordinary than extraordinary that others have testified. And to that, I would recommend the committee take a look at the tax notes article by Mindy Hirschfeld, which has a very different view of sort of the success of the business community in getting, quote, what it wants in the rulemaking process. So it still remains early in grading the act as a whole, but I think the early returns are promising, and I look forward to answering your questions. Thank you.
Thank you, Mr. Holtz-Eakin. Mr. Furman, you and Mr. Aiken are well-regarded institutionalists. You've been before the committee many times, and we've had a chance to parry back and forth. How would you respond to the testimony of Mr. Holtz-Eakin?
So first of all, I should say I agree with Doug's agreement with me about moving forward. And some of the ideas I have in my reform are actually very similar to some of the ideas that he's had. I think part of the bipartisan consensus, though, was revenue-neutral tax reform. And the idea was you're not going to worsen one problem, which is our fiscal outlook, while improving another, which is our tax system. And you're not going to, result in more corporations paying no taxes, and that was massively violated by this law. On some of the specific evidence, if repatriation is one of the most significant pieces of evidence in favor of the act, then there really is very, very little evidence in favor of the act. That money wasn't overseas. It didn't flow back into the United States. That money was mostly U.S. treasuries, agency securities, and other securitized instruments and bank debt. It was American capital to begin with. It was, for tax purposes, labeled as under a foreign subsidiary. Now, for tax purposes, it's labeled as a domestic subsidiary. As an economist, there's no distinction between those. You don't see any of that in the balance of payments, net data, and the like. And corporations weren't constrained in their ability to make investments by those tax labels.
Thank you. Mr. Holtz-Eakin, I just, in a word, could I ask you, as I have faithfully asked you for more than 25 years, do tax cuts pay for themselves?
No, sir.
Thank you. Ms. Wong, could you please explain how the IRS audit program is unfair to low-income taxpayers? And are you aware of any recently released data in the President's proposed 2021 budget that would address this?
So it's unfair in a couple of ways. The rates of audits on lower income filers is now way out of proportion to their contribution to the tax gap of taxes not owed and paid on time. But it also hurts honest filers and small businesses because they have to compete with tax cheats. Businesses and other people who are making evading and avoiding taxes part of their business competition strategy. So, and that's a lot due to the IRS funding cuts that we've discussed. The budget does indeed have a proposal to address that, as it has in previous years. It proposes $15 billion of restored funding over 10 years. That would still not take the IRS enforcement funding back to 2010 levels by 2030, but it would be a substantial reversal in the direction we've been going. And the administration's proposal recognizes that would save revenues many times over.
Thank you. Let me recognize the ranking member, Mr. Brady, for 5 minutes.
Thank you, Chairman Neal. Thanks to all the witnesses. And Dr. Furman, it's good to see you. We may disagree on conclusions, but I always appreciate your research and your integrity in these issues. Mr. Holtz-Eakin, so we've heard testimony this morning to improve our tax system, grow the economy. We ought to raise the corporate tax rate. And we've heard on the presidential trail, almost every Democrat's candidate's plans to repeal the Tax Cuts and Jobs Act and bring back the higher and uncompetitive 35% corporate rate. But isn't it true that since we passed our tax reform, 6 countries have already moved to lower their corporate rate? 3 of them are now below the U.S., so they're not standing still. I was in California the other day meeting with tech companies about how we grow the innovation economy even more in the U.S. And of those 15 countries or companies sitting around the table, all 15 had either brought their intellectual property back to the U.S. or had kept it here because our new tax code, made it more justifiable to keep that new intellectual property here in the United States. If we, in your view, if we were to repeal the tax reform tomorrow, going back to those higher corporate rates, so what's the likelihood of having a better economy with more jobs and rising paychecks?
I think it would be a bad mistake, quite frankly, and we would see a reversal of the impacts that I described earlier. We'd see losses of headquarters in international mergers and acquisitions. We would see, again, funds being trapped offshore and not brought back to the U.S. and deployed efficiently. And I just politely will disagree with Mr. Furman on that one. And we would see our firms at a tax disadvantage in international competition, and that benefits no one if we can't effectively compete abroad.
Thank you, and I notice we often get asked about, do tax cuts pay for themselves the way we score? I believe that for African Americans, Asian Americans, Hispanic Americans, for those who are disabled, for those workers without a high school degree, who are now seeing wage growth and job opportunities they haven't seen in a long time, and with American manufacturing each year being a loss of jobs. Today there's been about 500,000 new manufacturing jobs, but obviously impacted by trade and the global economy. I would say for many Americans, they believe it is paying off for them. But when we deal with the deficits, what approach you think works better? A stronger economy with lower tax rates and revenue starting to grow, or a weaker economy with higher tax rate? What's a better position for America and Congress to deal with the deficits?
I believe we will have to grow as rapidly as possible as the first step in dealing with the future fiscal outlook. It will be probably likely that we'll have to raise some revenue, and this committee would be thinking hard about tax reform 2.0 to do that efficiently and not inhibit growth and competitiveness. And we'll have to deal with the mandatory spending programs in a way that we simply have not in the past. All 3 have to be part of the recipe.
And I agree. Look, tax revenues coming into Washington are at record or near record levels. In fact, Americans, my message to you is you're sending enough here. Our problem is spending, which dramatically outpaces that. But we have to do both, grow revenue, and deal with our structural problems. We're an aging economy. Final point, we heard some criticism about Treasury here today. Seems to me when you rewrite the tax code as we did, it's a major undertaking. Rules and regulations have to be drawn to both implement and interpret what Congress intended. We completely rewrote the international tax code, moving to a territorial system, ending businesses' practices of importing their deductions and exporting their income to lower their rates. We rewrote and created the 20% new deduction for pass-throughs. We started to restrain interest deductibility, which I think is something Dr. Furman agrees with as well. We made major changes in expensing. So isn't it, you mentioned this, but isn't it normal for stakeholders to interact with Treasury as these rules and regulations are both drafted? They invite public comment for that before. Isn't that pretty, after the Reagan reforms, after any major reform, isn't that pretty normal?
This is very normal, and as someone who ran an agency to support the legislative and rulemaking process, you have an obligation to listen to the public and get their views. You learn things, you get data from them, and certainly I think it's underestimating the permanent Treasury staff to somehow suspect that they can't make up their own mind and that they're just going to take meetings and be told what to do.
Right. Thank you. Yield back.
I recognize the gentleman from Texas, Mr. Doggett, to inquire.
Thanks to all of our witnesses. There is no doubt, it's undisputed, that we have a president, President Trump, who is the historic leader when it comes to tweeting, when it comes to bragging, and when it comes to whining. But Dr. Furman, I would ask you about his record economically compared to the Obama administration on some key indices. When it comes to wage growth, I believe it's been slower after the tax law than under the last couple of years of the Obama administration. We know that business investment actually has gone down during the last 3 quarters, though I understand Mr. Holtz-Eakin blames that on Trump's easy-to-win trade wars. And we know that the number of corporations that paid no taxes at all went up after this tax law. We know that while President Obama was addressing the deficit, that the king of debt, as he describes himself, has nearly doubled the deficit as compared with the last period of the Obama years. And I was just wondering if you can explain to us, if you can account for why President Trump has been a failure in keeping up with the Obama administration on so many key indices.
Thank you for your question and for making those points. I think it's certainly the case that growth this past year, for example, was 2.3%. That would fall towards the middle to bottom of the range of the economic recovery. Job growth in the last year was 175,000. That would be the lowest in the last 8 years. You noted that wages, and that's correct, for wages adjusted for inflation, which is what workers care about, were up at a faster pace in the last 2 years under President Obama than they have been in the last 2 years. And I think when your economic policy is a combination of creating a lot of uncertainty on trade, a lot of uncertainty in the fiscal system, and just uncertainty in general, that's probably not going to have a hugely beneficial impact. I'd also add the immigration restrictions, which I think will be economically very damaging over time.
Thank you. Professor Kaiser, you described the action that the Treasury Department, meeting regularly with corporate lobbyists and their lawyers, had, that there weren't enough giveaways in the Republican tax law as it passed, that they've managed to expand those giveaways through what Ranking Member Brady refers a rewrite. It certainly there has, I believe he said, to accompany a rewrite. There certainly has been a rewriting over there. Hasn't that rewrite expanded the number of giveaways to these corporations on their taxes by tens of billions of dollars?
Yes, I would agree with that.
And I believe the total re-estimate that has been done by the Congressional Budget Office is that it's up about $110 billion, much of that relating to Treasury's wrongful action. Can you explain, under the Republican tax law, how a United States multinational can lower its tax bill on offshore profits by building a factory overseas?
Sure. GILTI, the minimum tax regime, allows an exemption for a deemed return on your assets abroad. So the more assets you have abroad, the less GILTI minimum tax you pay.
Do you believe that there are a number of new provisions in the tax law that benefit multinationals, encourage them to ship jobs and profits overseas, that should be closed, as I propose in the No Tax Breaks for Outsourcing Act that's now been joined by over 100 of our colleagues in sponsoring?
Yes, Congressman, I would agree with that.
The provision that is the FD2 provision is intended to provide an incentive to locate intellectual property here in the United States. How does it actually provide an incentive to keep physical assets overseas?
FDII is a deduction that is reduced by the amount of assets that you have in the United States. So the more assets you have here, the less FDII income you have that gets the deduction.
So I think really the question is not whether these provisions have been a failure in addressing the problem of outsourcing jobs and profits, but what this committee will do about it. We now have experience with this tax law. We know that it benefited these multinationals and a few individuals sitting at the top of the economic ladder, but the cost to our economy is immense in terms of debt, and our ability to do something about it is real, and I hope we will move forward on an outsourcing bill and other key reform legislation. I yield back.
Thank you. Let me recognize the gentleman from Florida, Mr. Buchanan, to inquire.
Thank you, Mr. Chairman. Being on the committee the last 10 years, the concern I had 10 years ago when we started talking about tax reform was little or no growth, 1.5%. We have, I don't know who everybody else is talking to, but in Florida, my friends, many of them across the country, we've got one of the best economies we've ever had. I don't care how you want to measure it. I don't care who you're talking to. In terms of small, medium-sized businesses, the psychology is an all-time high in terms of positive. We went through the early 80s in the recession, the early 90s, the S&L bank crisis, the 08 crisis. Anybody you talk to, they're very excited about. And what does that mean? That means more good-paying jobs. It also means, from a standpoint, that you're going to have to pay more for employees. Anybody that's been in business, and I've created thousands of jobs over the years, you know when you get where you don't have a lot of people in my area, ask them how things are going. I've got the work, I've got business, I don't have workers. You got to pay more. So it's positive every way you want to look at it. I don't know how anybody looks at it differently. The other thing I would just say quickly, in terms of the corporate tax rate and taxes in general, 75% of the reduction of taxes went to individuals and small businesses. Let's talk quickly about corporate rates. If you're not competitive in the world, the last 10 years being on this committee, I got tired every week of another company in terms of an inversion. And the bottom line, like a lot of my friends, we had this discussion a while back, the reason they're moving to Florida, Texas, and Nevada and getting away from high tax states is because at some point you're not competitive, people are going to move. They're not going to just take their net worth, they're going to take the jobs with them. Now, it's the same thing in terms of when you look at it in the global economy. They've got options. They're going to go other places. When you got the UK at 18%, we're at 35%, that's a problem. They're going to move that corporation. I remember being in Michigan when our biggest bank got acquired from a Chicago bank. I didn't like it because they weren't going to take the jobs, then they took all the jobs. So you have to be competitive. You don't have to be the lowest, but I can tell you for someone that's been on the committee 10 years, it gave me heartburn. Mr. Eaton, let me ask you just in terms of the impact this is having on small business and jobs. I see it as a huge winner. What's your thoughts?
Well, certainly more than 1/2 of all business income is taxed on individual returns as pass-through entities, and the rate reductions and other provisions in the TCJA are part of the small business expansion we've seen in recent years. I would add to that an enormous change in the regulatory environment, which I think has to be recognized along with the tax bill as pushing economic growth. We saw an average of over $100 billion of regulatory costs imposed on the economy for the $100 billion annually for 8 years under the previous administration. That number has been essentially zero. It's actually a little bit negative over the 3 years of the Trump administration. That's a night and day difference in the sort of macroeconomic regulatory environment. Small businesses noticed that right away. That's where we saw the confidence rise.
Yeah, let me ask you also, you mentioned that tax reform sometimes doesn't pay for itself. Revenues are up 4%. Our spending's up 8%. We've got a spending problem. And that's why day one I got here, I wanted a constitutional balanced budget amendment. You simply don't pay more than you take in, and if you do, you raise taxes or do what you got to do. I think it's immoral what we're doing. And they talk about the last couple of years with this administration, but the last 10, 12 years we've run up $10, $12 trillion in debt. Every year we've averaged $1 trillion in debt. So the bottom line is, when you say they don't pay for themselves, explain better what that means. Revenues are up 4%. I think that's pretty good based on, the jobs and the economy and everything moving forward very aggressively.
Well, let me first say, I agree that it is an imperative for Congress to get serious about the spending side of the budget. The threshold decision is the decision to spend the money, then you figure out how to pay for it, borrow the money or raise taxes. Taxes paying for themselves would require that you cut tax rates, say, and as a result of that action, you have no additional debt. Well, that's not what happens. You get some debt, then revenues rise, it's true, and they get past perhaps the previous baseline, but you don't erase that original loss in the 10-year window.
I just got 26 minutes. My goal on tax reform was to make America and Florida, all the states, the best place on the planet to do business, and you can do that through having competitive tax rates, regulations that make some sense, and yes, we can have an environment that makes sense as well. With that, I yield back.
Thank the gentleman. Let me recognize the gentleman from California, Mr. Thompson.
Thank you, Mr. Chairman, and thank you for calling this important hearing on the disappearing corporate income tax. Mr. Holtz-Eakin, do tax cuts pay for themselves?
No.
Thank you. Tax legislation should be enacted, I believe, in a bipartisan and fiscally responsible manner, with careful consideration given to the law's effect on the nation as a whole. The Republicans' tax cut didn't come remotely close to paying for themselves by turbocharging the economy, as the president repeatedly promised. It did substantially lower effective corporate tax rates and generate about $1 trillion of stock buybacks and dividends for shareholders. A May 2019 Congressional Research Service report found that the Republican tax bill had little measurable effect on the overall U.S. economy in 2018. And according to a January 2020 Congressional Budget Office report, the U.S. government's budget deficit is projected to reach $1.02 trillion in 2020, as the federal government continues to spend much more than it collects in revenue. This year's deficit would be an increase from 2019, when the government deficit grew to $984 billion. The deficit in 2016, President Obama's last full year in office, was $585 billion. CBO now projects that the deficit will be at least $1 trillion each year in perpetuity unless Congress makes changes. It was clear when the tax law passed it was going to produce a large windfall for the wealthiest and big corporations and exacerbate the deficit. 2 years out, the deficit is projected to reach $1.2 trillion, and the decrease in corporate tax revenue is even larger than was expected when the law was passed. With apologies to Jerry Reed, it sounds to me like corporations got the gold mine and the taxpayers got the shaft. I'd like to start with a question for you, Professor Kaiser. How were corporations able to use strategic tax planning following the Republican tax law to lower their taxes more than expected?
When the tax rate is lowered, there's an incentive to accelerate deductions to the year in which the tax rate is higher and defer income to the year in which it is lower. So the incentive is to accelerate deductions to 2017 and defer income to 2018 in the case of the corporate rate change. And the JCT report that was just released yesterday shows that there's data indicating that that certain deductions were in fact shifted. Deductions for contributions to employee benefits programs, bad debt expense deductions, deductions for wages and salaries generally. And the JCT report also notes that there is some evidence of deferral of income to 2018.
And are there things that Congress could do differently to make it harder for corporations to game changes in the law?
Yes, you could have certain phase-ins that I think would address some of these problems.
Professor Furman, the one-time tax on deferred foreign earnings was one of the largest pay-fors in that Republican tax bill. And what can we expect to happen to corporate tax revenues once we're done collecting the one-time tax on deferred foreign earnings?
Yeah, that one-time tax will go away, and so the cost of the other provisions will rise. There's different things moving in different directions, but this is why corporate tax revenue stays very low relative to the economy, which is how most economists, I think all economists would measure it.
There are a number of things that phase out in the bill, but the big cost items stay forever, and this being one of the phase-outs. So what can we expect to see once that phases out in regard to the deficit?
Right. We would get less revenue, and if Congress extends some of the provisions in the Act or cancels some of the offsets, you would get even less revenue than what you see on paper right now.
And deficits would
go up. Deficits would go up.
Yeah. Thank you very much. Mr. Chairman, I yield back.
Thank the gentleman. Let me recognize the gentleman from Nebraska, Mr. Smith, to inquire.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. I do first want to say that listening to some of these exchanges certainly reminds me of the rhetorical exchange leading up to tax reform, and I'm still surprised that some of the arguments existed then, and I am still surprised today that some of the opposition that was stated then is still firm today, despite some of the other realities. I would like to focus on, I don't want to proceed without mentioning that certainly President Obama called for reducing the corporate tax rate. And I think there was common agreement there. The argument was how competitive. He wanted us to be more competitive. Not a lot was done in that direction, but we needed to have a more competitive corporate tax code. And I think we were very serious in accomplishing that with our tax reform efforts. I would like to focus on a couple major problems with Ms. Kaiser's testimony. First, that base broadening provisions in TCJA were insufficient, that assertion. In addition to lowering the corporate rate to make us competitive, we went from a worldwide system where every dollar a U.S. company makes anywhere is subject to tax to a system that matches pretty much every other major economy where your profits are taxed where they are earned, with exceptions to prevent tax avoidance. Those exceptions were acronyms known as BEAT and GILTY. BEAT to keep companies from shifting profits made in the U.S. to low-tax jurisdictions, and GILTY to keep companies from moving their intangibles like intellectual property to low-tax jurisdictions. We want U.S. companies to do business worldwide in as many countries as possible. What we don't want is U.S. companies shifting profits solely into low-tax jurisdictions. I think we all can agree that Treasury should first and foremost be implementing legislative intent, and when we enacted TCJA, our intent was to prevent targeting income solely into tax havens, and Treasury got that right. I would for a moment like to ask the panel, just for a one-word answer from each of you, that setting aside rates, deductions, and so forth, do you believe the U.S. should have tax on a territorial basis like most other major economies or on a worldwide basis? Dr. Furman?
A hybrid system between those two.
A hybrid system, okay.
I'd agree with that.
Okay. Ms. Wong?
Territorial.
Territorial, okay, thank you. I also want to address the assertions about CBO's supposed finding that these Treasury regulations cost us $110 billion. Dr. Holtz-Eakin, you were the CBO director, correct?
Correct.
Does CBO score tax policy?
They do not score regulations, and they don't score tax law.
And why is that?
The Joint Committee on Taxation scores tax law, and regulations are not scored. The purpose of the rulemaking is to implement the law consistent with the desires of Congress when it passed it, and it's not a revenue exercise.
Okay, thank you. Can you talk about the process for CBO updating baselines?
Sure.
Isn't it true that updating baselines is fairly routine, and do you believe the Bureau of Economic Analysis had any role in the $110 billion adjustment that is being discussed today?
So remember, people keep talking about what was expected, but this is the only time the world's largest, most successful economy will move from a system of worldwide to a system of territorial taxation. And we have enormous uncertainties about what would in fact happen, especially the timing of what would happen. So it's not surprising that things don't look the way they were in the Joint Committee scores or anything else. What CBO does when it does a baseline update is it says, okay, we now know some actuals. Let's look at what happened to the economy first, what changes in economic activity have run. One of the things that happened most recently is the BEA revised down corporate profitability over the past several years, and so the apparent decline in receipts the actual decline in receipts that started in 2015 was not because corporations were somehow moving their profits. Their profits just weren't there, and so CBO first recognizes that. It also looks at changes in law. If there were changes in law, it accounts for that. And what's left over is essentially the residual is a measure of our uncertainty. You have no idea where it came from. You can start maybe guessing, but there is no way to know for sure. And in this case, to say that $110 billion is due to rulemaking on international provisions, there's not one tax return that they've seen post-rulemaking. There's no score of a rule. There's no way to assign it to that in particular.
Okay, thank you. I yield back.
Thank you. Mr. Larson, a gentleman from Connecticut, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank all the witnesses as well for their testimony, and I especially want to thank the intellectual honesty of Mr. Holtz-Eakin and also my colleague, Mr. Smith, who just recognize that President Obama actually did propose tax cuts and was working diligently towards that. Coincidentally, he was blocked from doing that, along with judges and immigration reform and other things that he wanted to accomplish during his administration. But I thank you for your honesty, and I thank everyone here for their testimony. Like everything else, I believe that there are consequences when we pass legislation. And one of the consequences, and God, I've never met anyone who didn't like a tax cut. I don't care how poor, how wealthy, everybody enjoys tax cuts. But there are ramifications, including the debt that, as has been noted here today, that's built up, but also the disproportionate way in which it's achieved. And yes, I think people have said, wow, this is great. You know, my 401k is doing better. Stock market seems to be doing fine. But for the majority of Americans, they don't have 401ks. For 68% of millennials, they don't have 401ks. All they have is Social Security. And for the record, Mr. Chairman, I'd like to submit the budget statement yesterday from President Trump that cuts Social Security by $71 billion.
Without objection, such will be the order.
And with that, I'd also like to enter into the record a letter here from Dr. Furman and Dr. Summers that talks about the importance and significance of investing in Social Security long term. And I want to turn to
Without
Dr.
objection,
Furman.
such will be the order.
I want to turn to Dr. Furman and certainly ask your analysis of the shows there is no evidence that in the 2017 tax law has made a substantial contribution to investment or long-term growth. What impact do you think that is having on Social Security, and how detrimental, and this is the thing that gnaws away at us on this side of the aisle, it's great that people enjoy prosperity, but not at the expense of the everyday worker and someone who the only thing they have is Social Security. Dr. Furman.
Yeah, so I want to thank you for your work on the Social Security issues, and certainly additional economic growth would help Social Security just like it would help every other part of the budget. And we haven't seen growth rates rise in the wake of the passage of the act. And in fact, it would have been even worse had it not been for the very large fiscal stimulus the Congress passed on the spending side of the ledger, not the tax cuts. That's been the most important aspect for growth in the last 2 years.
And even more disconcerting has been this continued call to first refer to Social Security and Medicare as entitlements, when in fact, everybody in this viewing audience, and that's where I think sometimes in Washington we're illusionary in terms of what we think we're accomplishing with a specific piece of legislation, and then what's actually happening out in the real world. And when you find so many people, especially women and people of color, who are not benefiting, who are being left behind, and the only source that they have in their retirement, but not just their retirement, but in terms of disability, in terms of dependent coverage, is the safety net that is now being labeled as socialism. Well, guess what? President Roosevelt got it right, and it's long overdue that this Congress step up, especially knowing full well that on our watch, no one else's, that Social Security is paying out more than it's taking in, and there's remedies to fix it. Doing nothing will result in a 20% cut across the board. And this is the ramifications of what happens when we pass tax legislation, don't come up with a responsible way for paying for it, and then seek to do it on the backs of Social Security, Medicare, and Medicaid. I yield back.
I thank the gentleman. Let me recognize the gentleman from Texas, Mr. Marchant, to inquire.
Thank you, Mr. Chairman. I believe that tax reform has attracted billions of dollars of increased investment in the United States. I believe that there are some foreign institutional investors that could make for ideal partners for the projects we discussed in the infrastructure bill, infrastructure hearing last week, because these investors are looking for large-scale, capital-intensive projects that provide a long-term, steady investment. This committee could incentivize those investments even further. We should consider repealing the foreign investment in real estate property tax. Mr. Larson and I have introduced a bill to do that, and FIRPTA is an outdated discriminatory law. It imposes capital gains taxes on foreigners that invest passively in U.S. real estate. It applies to no asset class other than real estate and infrastructure, which is what we want to accomplish. Economic studies indicate repealing FIRPTA could drive $65 to $125 billion in new investment in infrastructure and capital. I'd like to, Dr. Furman and Mr. Holtz-Eakin to each make a comment about their opinion about repealing the FIRPTA law. Mr. Furman.
It's something I looked at a while ago, so I don't have an incredibly strong opinion for you off the top of my head, but I remember there being a set of issues that it did create along the lines of what you said, so I think it's certainly worth taking a serious look at repealing it. If it was repealed, I would make sure to replace that revenue with some other more efficient form of revenue.
Okay, so how would you, there is no revenue coming in now because the investment is not coming in.
Yeah, I don't know what the scored budget cost was, so if there wasn't a scored budget cost, then I wouldn't be worried about the revenue, but if there was, then I was, and you may be more up to date on it than me, but certainly in the Obama administration, we did take a look at this, and it did seem like there was some infrastructure investment that wasn't coming into the country as a result of it. It's worth looking at.
Mr. Holtz-Eakin.
I'm so glad I came today. I haven't talked FIRPTA in years.
Well, people don't like to say FIRPTA. It's weird when you say FIRPTA.
Yeah, I would concur. I think this is a law whose time has passed and should be repealed.
Would this action repealing FIRPTA further incentivize investments and create jobs here?
Yes.
How did tax reform help make the United States a more attractive place for foreign and domestic investment?
The provisions on the whole made it more attractive to invest in the United States. Tax rates lower, expensing, which I think probably should be permanent, but expensing at least for a while, all make this a more attractive place. And I expect after the uncertainty from the trade actions dissipates, we're going to see real evidence of more FDI directly into the U.S.
Thank you, Mr. Chairman. As we get more serious about infrastructure expansion and paying for that infrastructure expansion, I would like for this committee to take seriously the idea of repealing the FIRPTA laws. Thank you.
Thank the gentleman. Let me call upon the gentleman from Oregon, Mr. Blumenauer, to inquire.
Thank you, Mr. Chairman. Mr. Furman, I appreciate you sort of setting the stage here because you were involved with the prior administration, and I think I heard you correctly. Despite some of the assertions about the magic elixir effect of the Republican tax bill and the Trump administration policies, that actually the metrics that people can measure in terms of growth in GDP, actual increase in jobs, that those metrics were higher in the last 37 months of the Obama administration than in the first 37 months of the Trump administration. Did I hear you correctly?
Yes, Congressman.
It seems to me that these are areas that we can actually, ought to be able to agree. These facts that were occasionally disputed by candidate Trump because he felt that the Obama administration and the bureaucracy couldn't be trusted, that they would cook the books. These are his books that are being cooked, and those statistics belie the claims that are made. Ms. Kaiser, you outline areas where the opportunity zone morphed from the time it was slipped into this bill and not really discussed by the committee, and then it went through the regulatory process. You identified areas where the benefits that should be focused on improving the condition in depressed areas were watered down to reduce that benefit. Is that correct?
Yes, that is correct.
You want to elaborate on that for
Sure.
just a moment?
So
Just a moment. I want to move on.
Sure. The opportunity zones require that you make substantial improvements in the opportunity zone areas. Treasury has stretched this concept to include things like purchasing linens or mattresses, even gym equipment. These qualify as substantial improvements and are really going beyond the statute. There also have removed the requirement to make substantial improvements altogether from vacant land, which is, again, going beyond the statute. Thank you.
I think that is profound, sort of undermining the premise of this provision that, as I say, was slipped in without extensive committee discussion. Ms. Hong, you are talking about the challenges that are faced by the Internal Revenue Service, which has, as you document, has been hollowed out in recent years. We've had essentially a Republican war on the capacity of that organization to function, cutting back employees, for instance, and audit activities at a time when the number of returns has increased and the complexity, notwithstanding the claims from the Republicans that they were going to simplify the tax code. Remember the postcard return, making it much more complex, which is troubling. And we're talking about the tax gap between what is due and payable if everybody played by the rules and what actually shows up is approaching $400 billion a year.
Right.
And this puts people who play by the rules at a disadvantage to people who cheat or cut corners. And I would think there would be bipartisan support to fix that. Cheaters shouldn't get an advantage over people who play by the rules. In your testimony, you mentioned something that I thought was intriguing because the audit function, if it's done properly, actually generates far more money than it costs. A return of 5, 6, 7, or to 1 or more, depending on the targeting. And you point out that it is that the tax loss, the people who forget to pay the taxes, are concentrated in the wealthy. You suggest that there may be a mechanism that we could use to finance this outside normal budget rules, that it would be paying for it. Would you elaborate on that?
Yes, I think that's absolutely right. It's actually one of the very few things that pays for itself where tax cuts don't, but funding IRS enforcement does pay for itself many times over. So what has been previously proposed is to sort of take IRS enforcement funding outside of having to compete in the appropriations process for funding with other different sort of critical investments. And there are a number of ways that one can do that. The Trump budget had one proposal. The House had a proposal last year. Looking forward, because the appropriations process is now going to be different moving forward, we can think of different ways of doing it. But you're absolutely right. We should recognize that savings.
Mr. Chairman, I see my time has expired, but I would hope that this is something that our committee could spend a little time on, because this shouldn't be partisan. Nobody wants cheaters to have an advantage over people that play the rules. And if we can work with our friends to design a mechanism outside the normal budgeting process, I think this would be something that we could all agree on and would make a huge difference.
I think the gentleman is entirely correct on that. Let me recognize the gentleman from New York, Mr. Reed.
Thank you, Mr. Chairman. And Doug, I think you're the only man in America that got giddy when FERPA was brought up today. Let me start off with trying to just make sure we quantify the negative news here today at this hearing. And Ms. Kaiser, you are a very educated woman. I saw your portfolio. And so this year we're projected $1 trillion plus or minus of a deficit, correct?
Yes, I believe that's correct.
Okay. How much of that $1 trillion deficit is attributable directly to the tax cut, in your informed opinion?
I would like to reserve judgment on that. I would have to look into that.
So you have no knowledge of that today as to what the impact of the tax cut bill on the deficit is, even though that's a primary argument being raised here today.
I think there are many aspects of the deficit, and
But wasn't it 1.5 trillion over 10? So if it died, 1.5 trillion divided by 10 is what?
1.5 divided by 10 is less than
1.5 trillion divided by 10 is $150 billion, correct?
$150 billion.
So $150 billion is estimated to be the impact on the deficit of $1 trillion this year. Isn't that correct?
I guess so.
Okay. So how much of that $150 billion is attributable to the corporate tax reduction?
Again, I would have to look at the numbers. I think that the corporate tax reduction was estimated originally by JCT to be incredibly costly.
What's incredibly costly mean, if you're citing that reference?
I believe it was over
And Ms. Heng, you can help. You can help.
$100 billion
It's okay.
a year.
$100 billion a year, so only $50 billion is attributable to the individual tax cut, is your testimony today? Ms. Yang, is that what you're saying? Ms. Yang, we'll go to you. You have the numbers there.
I think Jay.
Oh, I think
Doesn't look like the panel knows these numbers very well. So if I can just do the math in my own head, obviously the corporate tax rate is about how many portions of the revenue? It's about $300 to $400 billion. Mr. Furman, Dr. Furman, you've been involved in this business.
Right.
Is about $300 to $400 billion out of the, how many trillions of dollars do we raise in tax revenue a year?
CBO's final estimate of the tax bill appears to be consistent after dynamics going with that 1.5 trillion over 10 years. Some of that cost was front-loaded. More than half of that cost is on the business side, if you include both corporate and pass-through. Finally, what adds to the deficit isn't just the tax cut, but the extra interest you need to pay on the debt associated with the tax cut. That actually grows over time.
But just so we're clear, if it's $1 trillion deficit this year and it's $150 billion a year over 10, times 10, we're talking about a significant delta between the trillion. My point is that should illustrate to America today that $850 billion of this is attributable to the spending side of the ledger, even under your own math, even under your own proposal. So let's get to the good news. And Doug, I'm going to focus with you today, please. Corporate tax reductions, my understanding of the numbers is there's approximately $10 billion that was, as a result of corporate tax reform, that went to electric, public power, and private power companies in America. Is that a reasonable number? Is that, for the record, yes?
To the best of my knowledge, yeah.
So $10 billion of benefit to electric companies, both public and non-public. Who gets the benefit of that $10 billion reduction to those utilities? Would it be the consumer, the utility user?
Yeah, they'll have to pass it through in the rate-making process.
So on the utility bill, as part of this corporate tax return, there's a benefit to a day-to-day taxpayer in their utility bill, right? And that includes businesses, but mostly individuals are paying those bills. Is that correct?
That's right.
So we got utility bills going down as a result of the corporate tax return. Let me ask you about wages. Wages are going up. What approximately is the average wage going up?
I think the
dollar-wise?
I think the best measure is the employment cost index measure of compensation, and that's going up at about 2.3% year.
How much does that mean in dollars to the average taxpayer?
If you take the median household income at roughly $50,000, 1% of that is $500, and so you're going to have $1,000.
$1,000. And to a hardworking American, $1,000 is a lot of money. I know it's not in D.C. $1,000 seems like pennies around here. But to, I know a family of 4 back in our district, $1,000 is a pretty good amount of money when the average wage is around $30,000 a year. Pretty significant dollar, right?
And I think the other thing to emphasize is that the labor market is performing so well that, for example, last week we created 225,000 jobs. If the unemployment rate was constant and labor participation rate was constant, all you'd get is population growth. That should be about 80,000 jobs. Yeah. We're drawing into work people who have been detached from it. That's a big benefit.
Let me highlight this, too. When we're talking increase in 225,000 jobs, is a job bigger than a paycheck? And what do you mean? What I mean by that, it's not just their checkbook. People who work for a living, what's their quality of life?
Much better.
Thank you. That I yield back.
Thank the gentleman. Mr. Thompson would like to have something inserted in the record.
Thank
I'll
you, Mr.
recognize-
Chairman. I ask unanimous consent to enter into the record an article in today's San Francisco Chronicle headline, PG&E, that's Pacific Gas and Electric, one of those utility companies that Mr. Reed was talking about, seeks a $1.4 billion rate hike for fire prevention and insurance costs.
So ordered. Let me recognize the gentleman from Wisconsin.
Thank you, Mr. Chairman. I want to thank all the witnesses for your testimony here today. Ms. Kaiser, I want to first start and thank you for the attention that you've brought to the Opportunity Zone. Since my name was on that original legislation, I want to make sure it's done right. It's implemented correctly, that we have complete transparency and accountability. But in your testimony here today, you've highlighted some of the deficiencies that Treasury and their rulemaking have come out with that I think warrant more attention. You know, the definition between unrelated, related parties, the expanded addition to the basis, non-statutory exception for vacant land. With your permission, I want to follow up with you in more detail. We won't have time this morning under the 5-minute rule, but certainly look forward to working with you to see what we can do to better improve the Opportunity Zone intent behind it. But Dr. Furman, let me turn to you, because you today, in both your written and oral testimony, made a very bold yet definitive statement, and I quote, that there's no evidence that the tax law contributed to investment or long-term growth. But it seems kind of counterintuitive for the average person out there. You'd think with a huge tax windfall, these corporations have got to be doing some form of investment that's going to contribute to long-term growth. If that's not occurring, why not?
So economists distinguish between effective marginal tax rates, which is the incentive that matters for businesses. That's what shows up in the types of models that Dr. Holtz-Eakin uses, CBO uses, I use, and effective average tax rates, which is how much you actually paid in a check to the government. If you look at effective marginal tax rates, they went up for R&D under the bill, the way it was written. They stayed about the same for equipment compared to the bonus depreciation we had in effect prior to it, and they came down for structures. And so it's because of effective tax rates were already on the low side that the bill didn't actually lower them that much, and so it didn't actually help the economy that much, but it did lower average rates, and that's what you get thanked for if you talk to a company. They're very happy because they're paying less taxes. They just don't have as much of an incentive to invest as you would think.
That's
from the headline
interesting.
numbers.
We've also received a lot of data, a lot of evidence that a lot of the corporations use the tax windfall for share buyback opportunity. With that too, is that a decision that they're making that draws away from type of long-term investment that could lead to growth?
Yeah, I think that's indicative of the fact that there wasn't a large change in what the profitable investment options were. Businesses will invest if there's a profitable investment option. Marginal tax rates will affect that. The amount of cash they have won't. That's why repatriations, CBO, others have found do not boost investment. That's why it didn't here either, and it just goes back to shareholders.
You know, Mr. Powell, the chairman of the Federal Reserve, is before Congress yet today testifying about his outlook and where the economy is going. And he is raising some worrisome indicators out there. Obviously, the ongoing trade war, the cost impact, and the uncertainty that the president has created with his trade wars, the coronavirus right now they're keeping an eye on, the repo market, obviously, huge increase in federal public debt, over $1 trillion annual budget deficits right now with no short-term or long-term plan, and that was certainly reflected in the president's budget that he just submitted to Congress this week. But also, interesting, a huge increase in corporate debt. Now, again, that seems counterintuitive. If these corporations are receiving this huge tax windfall, why are we seeing troublesome signs and a huge increase in corporate debt and what that might mean to our overall economy?
Right. We have a tax system that's long favored financing through debt instead of through equity, purely for tax reasons. And in some respects, this law, by letting businesses take full expensing, but still deduct a decent portion of their interest, exacerbated that, and in some respects would even encourage more debt.
I guess Chairman Powell is raising the alarm that if things do turn south, and they will eventually, that our corporations may get caught flat-footed with the huge amount of debt that they're carrying on their books right now, and it's something I think we need to be paying more attention to. But finally, Dr. Furman, staying with you, how do we get the revenue that we need balanced without destroying the type of investment and innovation that we want companies to do? Is there a better approach or a better plan?
Yeah, so the same economics we started with on the difference between the marginal effective tax rates that matter for investment and the average rates that matter for revenue is the basis for the proposal I made and included in my testimony that would increase tax incentives for business investment, would increase tax investments for R&D, which I think is quite important and was actually penalized under the law, I think one of the troubling and underappreciated aspects, and would allow you to actually raise the statutory rate while increasing all of those incentives. So I think if you do it right, you can get more growth and more revenue.
My friend Mr. Smith pointed out that under your watch, the Obama administration did recommend a reduction in the corporate rate to 28. We ended up with 21 with their tax bill. And I think the only reason we went that low is because the president opened up his negotiating position at 15. And that's the only way we ended up at 21. So I think it's something, again, that we're going to have to take a look at, Mr. Chairman, as we move forward. Thank you.
Thank the gentleman. With that, let me recognize the gentleman from Pennsylvania, Mr. Kelly, to inquire.
Thank the Chairman and all of you for being here today. And I don't want you to take this next question one way or the other, but can I ask you, do any of you run a business? Mr. Holtz-Eakin. The reason I bring that up is because unless you've been in that arena, and I always find it interesting to talk to people that have great theories and really can work wonders on a laptop but have never actually worked on blacktop, and I watch what's going on, and I think we talk so much, and the title of this is The Disappearing Corporate Income Tax. So I asked the committee, could you please take a look at the total economic footprint of corporations? And this is what we found, and this is really, because this is things you don't think of. So, and it's hard to see, but federal corporate income tax, this is what corporations pay. Federal wage and taxes, right? Wage taxes they pay. State and local property taxes on business property. State and local general taxes on business inputs. State and local corporate income tax. State and local excise tax. State and local unemployment insurance. State and local business and corporate license. State and local public utility taxes. State and local insurance premium taxes. State and local severance taxes. Pension programs, employer-sponsored health care. And I think one of the things at the time that I've been here, we've always got to find somebody to blame for not paying their fair share. Because there's some SOB out there, and it's usually some damn wealthy guy or some really very successful business that isn't paying their own way. Would you please tell me when you look at that you think these people aren't paying their own way? And I will tell you, some of the years I've been in business, because I have a business that I've run, it was established by my parents in 1953, and there are years when I did not pay 1 penny in taxes, revenue taxes, because we didn't make any money that year. However, we did have to pay all the other taxes that were due us. So whether you make money or lose money, you're still paying those taxes, but we keep concentrating on things and saying, you know what? Let's get those people out here and really cane them. Let's make them feel like a piñata on Cinco de Mayo. Let's blame them for everything that's wrong in our tax system. Let's blame them for not creating jobs. Let's blame them for not picking up on benefits. And let's blame them for not providing health care. And let's blame them, and let's blame them, and let's blame them, because it's all about identity politics. We watched the United States of America lose businesses day after day after day. And where did they go? They went overseas. Why? It wasn't because they hated the United States of America. It was just the rest of the world was more welcoming to them. And I find this interesting because, honestly, it does get down to a saying that's been around for a long time, and it's always, don't worry about the mule, just load the wagon. Well, I got to tell you, for years, the mule unhitched himself, or I guess you can't really call him or her, and walked away from pulling the load. Now, we can do all these things, these mental gymnastics, say, listen, they're not paying enough, they're not paying enough. Honest to God, if you never had to make payroll, and you tell people that do have to make those tax payments that they're not paying enough, you're going to get a different opinion. And that's why, Doug, when you don't have a chance to talk, I mean, this is incredible to me. My whole life has been about the 6th and the 21st of every month, because those are payroll days. And I've got to make damn sure that there's money in the bank to pay those. And I talk about borrowing money. I've got $22 million worth of new cars on my lot right now. It's all borrowed. Shows up as an asset, but it's not an asset to me. It's a hell of a liability. And then we say, well, the only reason these people borrow money is because there's an incentive to do it. We say, yeah, because we need inventory, and we borrow money, and we pay taxes on our profits. And let's say, let's just cut them off at the knees. Let's go after these SOBs. Let's really drag them across the coals, and let's make the American people think the real problem is the guy or gal that you work for. The real problem is in our towns, go around and look at libraries, look at a lot of public institutions, they always have somebody's name on them. And the name on it was usually something that was given to the community by somebody who was successful in their life. I just wish if we're going to concentrate on income and we're going to concentrate on tax revenue, please let's make sure that our whole purpose is to have pro-growth tax reform. We had it, and we still have it. And we now become the country where everybody wants to do business in again or start a business. The reason they didn't want to come here is because the burden of staying here was too great, and they found other places in the world to go. Why? It wasn't because they hated mom and dad and their kids and their grandkids. It's because they couldn't make a profit in America, so they went overseas to do it. So I'm just saying, look, there's a simple way to do this. You want to get more taxes? Let people be more profitable. You want to have more people have more money in their pocket? Make sure their wages rise. We've done that. Tax Cuts, Jobs Act, incredible. The growth, incredible. I know I'm over time, but I got to tell you what. I am so fed up with hearing that everything is about identity politics. We got to stop looking at that. It just drives me absolutely freaking nuts. Thank you, and I yield back.
Thank you. Thank the gentleman. Let me suggest that we, now consistent with committee practice, we will proceed to a 2-to-1 question ratio and recognize the gentleman from New Jersey, Mr. Pasquale, to inquire.
Thank you, Mr. Chairman. Let's get back to the videotape. At the end of 2017, my friends on the other side of the aisle jammed into law a very reckless bill. The GOP tax scam, as it's now known, was a massive $2.3 trillion giveaway to big business and corporate tycoons at the promise that the GDP would rise to 6%, 5%, 4%. In passing this monstrosity, they packaged it as an engine for an economic boom. They said it would usher in a renaissance of job creation. Thank God we have these 1, 2, 3, 4 panelists. Regardless of where they stand politically, these are bright people. We should listen to them. If we put the 4 of them in a room, we'd come out with an answer. Instead, we keep on using lipstick on the pig. None of it happened that they said was going to happen. Good propaganda. Now we have a corporate income tax that is collecting the least amount as a percent of GDP ever. So corporate tax receipts have dropped like a stone in the stream, and the secretary for the boss is going to pay higher than the boss in terms of rates. It was that 4 years ago. Now it's going to get worse, and it is getting worse. So where's all the money going? I'm not wearing a trench coat, but let me put on my Lieutenant Columbo hat. Is big business investing the money it got? Nope. Got charts in front of me, if you care to look at them. Business investment lags substantially behind the average of the quarters that preceded the tax scam. Is big business giving more to their workers? Not really. Look at the numbers. After adjusting for inflation, both hiring and real wage growth have been lower since 2017 than they were during the end of President Obama's tenure. Remember him? And household income increased to only $550 in the first year after the tax scam. You may be stunned to find the money ended up in the pockets of corporate executives and shareholders. We're not stunned at all. The corporate tax cut fueled over $1 trillion in corporate stock buybacks. That's where. And just when we thought the tax scam couldn't get any worse, the Treasury Department has gifted large multinational corporations even more money through the rules to implement the scam law. No, maybe they're not in business, but they understand the bottom line, and they understand what gets us to the bottom line. The GOP tax scam is emblematic of our broken corporate income tax. All of us wanted to see corporate taxes lowered, percentage. Rangel and Pasquale introduced that 10 years ago. But we didn't say cut the legs out from under. put that secretary in even a worse condition than she's now. The most recent 10-year CBO budget outlook revised the government's expected tax revenues downward by $110 billion. This is money that should have been available to spend on health care, roads, bridges. Oh, remember them? Infrastructure promises, put people back to work. And our challenge goes to simply enforcing a fair tax code. Years of sabotage have destroyed the IRS's ability to stop the rampant tax invasion. They go after the EITC person faster than they do the multimillionaires. The IRS must have adequate resources to train its auditors, hire new ones to go after tax fraud by those who make in the upper 1%. Right now, the audits, I'll repeat, of the less affluent and EIT recipients are more common than the big business tax cheats. Some corporations pay nothing. How can you explain that? It isn't a question that they didn't make the profits, as was pointed out just a few moments ago. So I look forward to our expert witnesses again and again and again. But I have one final question, and I'll maybe get an answer from you later on, if I may. Enter into the record where I'll get the answer to the question. Dr. Holtz-Eakin, I have a tremendous respect for you to come here and listen to this all the time after you're trying to get to center. I know where you're going. I'm not saying this, I mean it. But in 2019, business investment growth decreased to 1.8% compared to 4.4% in the year before the tax package passed in 2017. The business investment growth was negative in the last 3 quarters of 2019. How do you explain corporate America's lack of sustained capital investment after the massive stimulus provided by the 2017 tax cuts? If you get back to us, I would really appreciate it. Thank you, Mr. Chairman. I yield.
Thank the gentleman. Let me recognize the gentleman from Illinois, Mr. Davis.
Thank you, Mr. Chairman, and I thank you for calling this informative hearing. And certainly we want to thank all of the witnesses who have been with us. A report by the Institute on Taxation and Economic Policy, ITEPS, determined that 91 corporations in the Fortune 500, all profitable enterprises, paid no federal income taxes in 2018 or even received a tax rebate. In total, the report found 379 Fortune 500 companies that were profitable in 2018 and provided enough information to calculate effective federal income tax rates. This was a sharp increase from ITEP's last pre-TCIA report on Fortune 500 corporate tax avoidance, which found that 29 profitable companies paid no U.S. income taxes in 2015, the latest year studied. Even among those big corporations that did pay taxes in 2018, it was on an average at a rate of 11.3%, a little more than half the statutory rate of 21%. Director Wong, when compared to what the average working tax-paying family pays, is this what one might call fair? And how is it allowed to keep happening?
Thank you. So those figures reflect what you see even if you were to look over time, and even if you were to add in state and local taxes, and even if you were to add in taxes paid by shareholders sometimes, that effective rates across the board on very large companies are quite a lot lower than the headline rate. And one would expect that to be the case even more so after the 2017 tax law.
Professor Furman, what group gets the most benefit from the massive tax cuts of the corporate income tax rate Is it the shareholders, or is it those individuals who work each and every day producing whatever it is that the corporation generates?
Yeah, the large majority of the incidence of the corporate tax cut is on owners of capital and shareholders. They're the ones that get the majority of the benefits from that tax cut.
And the myth that they were going to now invest back into redevelopment, developing so that other people will have an opportunity to work, seeing any experiences of that?
I think if you did a well-designed tax reform, you could actually get that, and you could get that without losing any revenue, potentially even while gaining revenue. I think in many respects this was a poorly designed tax reform, and so we're not seeing it in the investment data. We're not seeing it at all in the wage data either.
So out of the massive tax cut that we experienced, we got a lot of promises made, but no promises kept. Thank you very much, and I yield back.
Thank the gentleman. Let me recognize the gentleman from North Carolina, Mr. Holding, to inquire.
Thank you, Mr. Chairman. I think it's clear that our old tax code was broken, and in 2017, we took a bold step to reform the code for the first time in more than 30 years. Because of these changes, we've seen unemployment drop to historic lows, wages growing at their fastest rate in more than a decade. Chief among the changes to the code was an overhaul of our corporate tax system. Prior to TCJA, our combined tax rate was 38.9%, 15 percentage points higher than the OECD average. Further, prior to TCJA, we had a worldwide system with deferral that hampered U.S. companies and trapped cash offshore that would otherwise have been invested in the United States. The changes made by TCJA finally moved the U.S. to a territorial system, eliminating much of the tax disadvantage faced by U.S. companies, making the United States more attractive for investment. If we had not acted, we would have continued to see foreign inversions and acquisitions that eroded the U.S. tax base. So, Dr. Holtz-Eakin, could you talk a little bit more, expand a little bit more about base erosion that we had seen prior to TCJA and how this trend has changed since the enactment of TCJA, and how these changes have impacted the investment landscape here in the United States?
Well, certainly the most visible erosion was in headquarters, where we were seeing annually 3, 4 very large, very successful U.S. multinationals move their headquarters overseas. And that was a purely tax-driven decision, because anytime you had a cross-border merger or acquisition, which you would do for normal business reasons, for locational advantages and a variety of other reasons, if you run the numbers, we have the only worldwide system. Everyone else is a territorial system. We've got the highest rate. You don't want the headquarters in the United States. And so that erosion and the things that would then go along with it, ultimately long-run investment decisions that would be outside of the U.S., employment, income, I think were a real threat. And seeing that stop has been the most beneficial thing quickly out of the Tax Cuts and Jobs Act. There's also the issue of investment incentives in the U.S. having a lower rate. Average rates do matter in the following respect. If everyone has a territorial system and you've got one average rate that's 10%, another one is 20, you want to be in the 10. So the average rates do matter. We got our average rate into the ballpark. We used to have high average effective rates as well. That makes this a better place to locate investment on the globe. And that includes both keeping what would have been domestic investment as domestic investment and attracting foreign direct investment into the United States. Those are important steps that I believe are going to pay off over the long term. The reality is we haven't seen the long term yet, so we're going to have to wait.
Excellent, we agree. And I'm going to yield the remainder of my time to Mr. Kelly.
Thanks, and Doug, I wanted to go over because we talked about this previously. And so I showed the slide of what all the taxes that were paid by corporations. Now, I don't want this to come as a shock to anybody, because I think even in Washington, this is a large figure. The total business, federal, state, and local taxes in financial year 2018, the tax burden on these corporations that aren't paying their fair share was $1,560,041,757. It's $1.5 trillion. Now, I don't care where you are. That's a lot of money. That's a lot of money. And so I often think that sometimes if we could get away from looking at what the problem is, look, we don't have a revenue problem, we have a spending problem. But in order to fix that spending problem, I think you'd agree with me, so 70% of our budget is mandatory, we have to spend it, is that right? 30% of it's discretionary, so we can change that around a little bit. But to go into that 70%, you're going to be affecting programs a lot of people just say, we just can't touch those, even if it made sense. I mean, it's like asking Superman to play with kryptonite. You're just not going to touch those programs because there's elections to come up, and if you do that, somebody's going to run an ad on how you tried to cut Social Security, how you tried to cut Medicare, Medicaid, well, you name it, and you're going to be the guy wearing the black hat. But the reality of it is, it doesn't matter how much revenue we generate. We can't keep up with our spending. When $7 out of every $10 you have by law has got to be spent, how in the world would you curb it? So what am I not getting here? I mean, it's a spending problem.
I have felt for a long time that we needed to take on the growth rate of spending programs. Over the next 10 years, Medicare is going to grow at an average rate of 7% per year. There isn't a revenue base that's going to grow at 7% a year. And that's symptomatic of what goes on the mandatory side of the budget.
Okay.
Thank the gentleman. Let me recognize the gentlelady from California, Ms. Sanchez, to inquire.
Thank you, Mr. Chairman, and to our witnesses, thank you for sharing your expertise with us today. There are a lot of directions that I could go with in my time, but I want to focus on the human impact of the recent Republican-led decisions on taxes. And I just want to start with the simple premise that nobody really loves paying taxes, but we all love what taxes pay for, roads and bridges and schools and libraries and hospitals and all of the things that we need for a good quality of life. I think that most people don't mind paying taxes if they feel like there's some fairness and like they're not being targeted unfairly and somebody else is getting a lighter load, so to speak. Each year we ask the IRS to do more and more with less and less. We have IRS staffing that's declined by nearly 20% in a decade. 20%, that's on top of a staggering amount of work to pile on top of the people that are left there. And I raised that issue last year during our hearing on the tax gap with the Treasury Inspector General. High income earners, most especially multinational corporations with large tax and legal departments, they engage in tax avoidance and tax evasion. But the current IRS audit program targets low-income tax earners for audits. So you got people that are earning a heck of a lot of money, and we're pretty much turning a blind eye, and we're going after the little guy who is struggling and paying their fair share. So not only are our audit priorities out of whack, but we have dangerously cut IRS budgets. And those budget cuts means less ability to bring in the taxes that are owed, the taxes that pay for all the things that we need, like roads and bridges and schools and libraries and hospitals. There are 8,000 revenue agents examining tax returns this year, while there were nearly 15,000 doing so just 10 years ago. I want to start with Ms. Wong. What damage has the decrease in IRS funding done to the fairness of the tax system and on the workforce itself, those who are charged with carrying out the priorities that are handed down to them?
Well, as you pointed out, the place where it's had the biggest impact is audits on large corporations, wealthy people, big businesses that have complex finances. And the thing is that they often have complex finances because they've been set up that way to avoid or even evade tax in the first place. So there's been a big drain of those experienced staff needed to pick through those returns, and without funding to hire and train staff who've been retiring, it's really very difficult for the IRS to give those returns adequate attention.
So they're kind of getting off on a lighter part of the load. Would that be fair to say?
I think so.
And if I'm a working parent earning minimum wage and claiming the EITC, the Earned Income Tax Credit, am I more likely to be audited than a corporation is?
So for many types of corporations, yes, and about as likely as for the wealthy filers who tend to own the bulk of corporate stock and large businesses.
So I'm somebody who's struggling to get by, I have children, I'm trying to claim the credit, and I'm more likely to get audited than these guys that have all these complex structures to try to evade taxes. Finally, I just want to make a comment. It's already been inserted into the record, the President's budget, which was released yesterday, and I note with some interest that in the President's budget, he cuts business audits by half for 2021. Does that sound like a way to rebalance and to create fairness in our tax code, Ms. Wong, or does it sound like further people with the most money getting further lightening of the load that they have to, that everybody should bear, I should say?
So I think the right way to focus would be to take, to build on his proposal to actually increase IRS enforcement funding and to ensure that that added back resource goes towards auditing those who disproportionately contribute to the tax gap, which are the larger corporations and businesses and wealthy filers.
So when I hear people say we have a spending problem, not a revenue problem, if you have large, complex multinational corporations who aren't paying their fair share because they engage in tax avoidance or tax evasion, they went into Treasury to argue to get even lighter tax burden. They got their taxes cut the biggest out of anybody in the 2017 tax cut. Is there any wonder that people who are struggling to get by are sick and tired of this and feel like the system is stacked against them? Would you agree, Ms. Wong, that it pretty much appears that the system is stacked against everyday families that are just struggling to get by?
I would agree, and I think that's a real problem for voluntary tax compliance, because when people start seeing that other people are getting away with not paying their taxes, that's a real threat.
Thank you, and I think the chairman, I yield back.
Thank the gentlelady. Let me recognize the gentlelady from Alabama, Ms. Sewell, to inquire.
Thank you, Mr. Chairman. During the passage of the Tax Cut and Jobs Act, we were told that this legislation was a key to America's competitiveness and continued economic growth. We were also promised that the law would result in a flood of new investments in our manufacturing sector, which is so important to jobs and economies in my Alabama district. We were promised a $4,000 raise for every worker, and we were told that we would see up to 6% economic growth. We were even promised that the $2.3 trillion tax cut would pay for itself. But 2 years after the enactment of the law, we can see that the Tax Cuts and Jobs Act has not lived up to these promises. Instead, the law has been a windfall for corporations and the wealthy, while working families in my district continue to struggle to afford basic needs like housing, groceries, and health care. Wage growth hasn't kept up with the overall economic economy and growth, and we haven't seen the robust capital investment that we were promised. In fact, a recent analysis from the International Monetary Fund shows that the large corporations use 80% of their increased cash flow on buybacks, dividends, and other asset planning adjustments. Meanwhile, only 20% of this cash flow went towards capital expenditure or research and development. During much of last year, we actually saw manufacturing output shrink rather than grow. Instead of investing in workers and families, we are sheltering away trillions of dollars without much to show for it. Professor Furman, your testimony examined the impact of TCJA on business investment. Can you talk more about some of these trends, and particularly what we're seeing in terms of manufacturing and investments that this bill has brought about?
Yeah, we've seen investment decline for 3 straight quarters. We've seen business fixed investment take out the volatile oil and gas sector, grow at the slowest pace that it has for the entire economic recovery. We've seen job losses in manufacturing recently, and the manufacturing sector in general doing considerably worse than the trajectory it had been on prior to the passage of the law. And all of this is manifested ultimately for people. The CBO found that incomes after taxes and transfers are barely rising for the bottom 80% of the Americans and are rising quite strongly for the top 1%.
Likewise, Ms. Wong, my colleague, Ms. Sanchez, touched on this, but it's been very troubling for me that we've seen an increase in audits on earned income tax credits for working families. I know that in my rural part of my district, the Alabama's Black Belt, many of those counties have been hard hit by the disparity across the country in audits. They've been audited mostly for lack of incorrect information, not for fraud, lack of really being able to fill out those forms. And that's particularly troubling when you look at the president's budget. He proposes to actually have a further cut in audits for businesses, when here you have working families really trying to seize upon a tool that we all believe in, the Earned Income Tax Credit. Can you talk about how this is unequitable and how this disparity really does affect working families?
Yes, so I think, yes, EITC audits are now a much, much larger share of all audits than they are of the tax gap. And as you said, a lot of that is error. This is what happens when complex families meet complex rules, and you have an IRS that is so under-resourced that they can't answer the phones to help people fill out their tax returns. Meanwhile, the people with the very most complex tax returns are seeing their audit rates absolutely plummet. And that's opening up a further disparity. And I also would just like to say, I think, these error rates shouldn't be used as an excuse for not expanding these credits, which are such an incredibly important part of the lives of people in districts like yours and across the country. But unfortunately, that's exactly what the 2017 tax law did. It opened up new loopholes for businesses while failing to boost the EITC and leaving 26 million children out of its full child tax credit increase.
Exactly. Mr. Chairman, I think that we should really investigate and dig down a little bit further about these audits that are happening on EITC. As we all know, the Earned Income Tax Credit, the Child Tax Credit, these are the tools that we, this committee, have tried to bolster to help working families. And I think we need to get to the heart of that and make it easier for them to be able to get these tax credits and not harder. Thank you very much, and I yield back the balance.
Thank the gentlelady. Let me recognize the gentleman from Missouri, Mr. Smith, to inquire.
Thank you, Mr. Chairman. I want to start by looking at a couple different facts. Before the Tax Cut and Jobs Act, there was no concept of a global minimum tax or anything remotely similar to a base erosion tax. Now with the Tax Cut and Jobs Act, we have both guilty and beat. What my friends on the other side of the aisle are failing to acknowledge is that these are significant policy changes. Congressional Republicans and President Trump changed the way taxes are done on a global scale, and now the rest of the world is following. Meanwhile, congressional Democrats seem to be very hung up on how the Treasury regulates, the Treasury regulation process works, something that's written in the Administrative Procedures Act, and what CBO did or did not say, even though they don't score tax legislation. Mr. Holtz-Eakin, since my colleagues are stuck on the topic of corporate tax receipts and seem to have failed to consider CBO's most recent statement, I'm hoping you may be able to provide some clarity. A simple true or false will work. Would you agree that part of the reason corporations will have less taxes to pay from 2020 to 2026 is because they actually paid more transition taxes in the 2018 and 2019 period of the new law?
True.
And isn't it true that in CBO's blog post, they published last Friday that they increased their estimates of the average tax rates corporations would be paying, meaning that corporations are actually paying higher taxes than they initially thought?
They raised the average tax rates, yes.
So that's true. And one more question. Correct me if I'm wrong, but we won't have access to detailed information from corporations' income tax returns from 2018, the earliest year to see the effects of the Tax Cut and Jobs Act, until later this year.
True.
True. Well, then it looks like this hearing is entirely premature. We're talking about how corporations haven't paid their fair share, and we don't even have the data. But we have the talking points, and that's what we're hearing in this committee. I hear a lot of the people on the other side of the aisle talk about the president's budget that was released yesterday. It's easy to criticize something when it's put out there. I'd love to see Nancy Pelosi in the House Democrats' budget. I serve on the Budget Committee as a representative from this committee, and yet since they've been in the majority, they have not even filed a budget because they all can't get along. They can't put their Green New Deal, they can't put their increases of taxes because they don't want the American people to see their values. As Nancy Pelosi said, a budget is a statement of your values, yet Nancy Pelosi and the House Democrats have failed to ever present a budget in this Congress. So go ahead and criticize President Trump for doing his job, but start doing your job and present a budget so we can review and make sure the American people see what you stand for. When we're talking about tax cuts for wealthy, let's talk about the state and local income tax. Oh, wait, that's wealthy people that you want to help support. In Southeast Missouri, the median income for a family of 4 is $40,000 a year. $40,000 a year. That's working class. Those are people barely getting by. Do they use the state and local tax deduction exceeding $10,000 like the wealthy folks in New York and California, New Jersey? My people in Southeast Missouri don't need to be subsidizing your wealthy people on the East and West Coast. What about electric cars? Your wealthy people use the tax code to get subsidized to purchase electric cars. But that's okay because it's your wealthy people. Let's be serious. Let's talk about growing the economy. We have record unemployment for all different classes of people. We have the highest wage increases of the low-income bracket. Let's celebrate that instead of just going after someone because you don't like them. The president's doing a wonderful job, and let's keep fighting and working for the American people and put people before politics instead of your talking points. I yield back.
Thank God. The gentleman yields back. The chair now recognizes the gentlelady from Washington, state of Washington, Delbene. Ms. Delbene.
Thank you, Madam Chair, and thanks to all our witnesses for being here today. Appreciate your time. Professor Kaiser, back when the corporate rate was 35%, folks talked a lot about how that wasn't the real rate that corporations paid because many of the tax benefits that were out there allowed corporations to reduce their income on which that rate was measured. Do you agree that the effective rate prior to the Republican tax bill for corporations was lower than 35%?
Yes, that's correct.
And so now that the statutory rate has been lowered to 21%, we haven't talked much about all the tax benefits that corporations had previously used to lower their rate, to lower their effective rate. And so did the Tax Cuts and Jobs Act, the Republican tax bill, eliminate all those provisions that existed under the previous law? No. I think you said no. And so while there were certainly some provisions that were base broadening, like limitations on interest deductions, given your testimony on how weakened those provisions were by Treasury, is it safe to say that the effective rate of corporations still remains well below the statutory 21% rate?
Yes, and the guilty rate of 10.5%, it's probably also below that.
So do we have any idea of how much lower the effective rate is?
I think we will need to wait to get more information on that, but there is evidence that, that CBO's original estimate that 80% of profit shifting incentives were maintained in the new law, that's bearing out to be true.
Thank you. When Republicans were jamming their tax bill through in 2017, there were many concerns raised, including by myself, that tax cuts for corporations were permanent while individual tax cuts were temporary and not giving individual certainty. Dr. Furman, in your testimony, you point out that the Republican tax law contained numerous tax cuts that phase down or out, as well as numerous tax increases that phase in. Many have focused on individual tax cuts expiring, but in fact, there are quite a few of these provisions built into the corporate tax changes as well. I wondered if you could briefly explain what those are and what the consequence might be if Congress were to repeal these tax increases that Republicans relied on to meet their $1.5 trillion budget, and because obviously corporations will be asking folks to do that.
Yeah, the tax law includes provisions like the amortization of R&E, which starts, I believe, in 2022, changes the definition of the limitation of interest deductions to expand them, raises the tax rate on GILTI, and expensing phases out. Some of these changes in the tax code may be good, some of them may be bad, but any one of them that you canceled would raise the total cost, and unless that was offset somewhere else, would mean would increase a certain set of the damage that the law did.
And then we dig an even deeper hole.
Exactly, dig an even deeper hole.
Ms. Wong, over $300 billion in deferred foreign earnings were reported as part of the one-time transition tax. Do you have any concerns about the IRS's ability to audit corporate earnings going back to 1986 that were included as part of the transition tax?
Yes, the IRS is severely depleted, so its ability to do any complex types of auditing has taken a big hit.
I think when we see a rush process and things not being well thought through, we end up in situations where we get results that we probably could have predicted but weren't thought through in this bill. And many new provisions and changes to provisions that we're seeing the impact just now. So we have a lot of work to do in terms of audit process, in terms of understanding the impacts of what's already been put in place and get more data so we see what that effective rate is going to be. Thank all of you. I yield back, Madam Chair, or Mr. Chairman.
Thank the gentlelady. Let me recognize the gentlelady from California, Ms. Chu, to inquire.
Thank you, Mr. Chair. Professor Furman, one of the major scams of the 2017 Republican tax bill is that corporations would reinvest their massive tax cuts back into their businesses and their workers. However, we know that corporations spent over $1 trillion to buy back stocks instead of investing in their businesses, paying workers better, or passing those savings along to customers. For example, Eli Lilly, one of the largest insulin producers in the world, lowered its tax rate so much that actually it had an effective tax rate of negative 9.1% on its $9 billion earnings of 2018. But what did they spend their enormous profits on? In that same year, Eli Lilly spent $6.5 billion on payments to shareholders in the form of buybacks and dividends, and its CEO made over $15 million. In the meanwhile, American consumers appear not to have benefited at all from this because Eli Lilly charged diabetes patients $300 per vial for their blockbuster Humalog brand insulin, and even their supposed low-cost generic was priced at nearly $150 per vial, while the same patients in Canada can get that drug for $32. So, Professor Furman, can you explain who benefits from these stock buybacks and what impact do these stock buybacks have on the wealth gap in this country?
Sure, Congresswoman. Thank you for your question. There's no major American corporation whose investment is limited by the amount of money it has on hand. Most of the major corporations have significant amounts of cash they can use to finance investment and also have ready access to capital markets. So if you give those corporations more cash, it's not going to lead them to invest more because the cash had nothing to do with why they weren't investing before. You need a stronger economy, better educated workers, better infrastructure, all the things that justify increased investment. So if you give those corporations cash, they'll pay it out to stockholders. Those are towards the very top of the income distribution, and that will widen income inequality. Another way of saying the benefits of those tax cuts go to the shareholders and owners of capital, not to workers in the economy more broadly.
In fact, Professor Furman, it seems that the average worker has not benefited under this tax bill. In fact, the American people were told that these massive corporate tax cuts would allow companies to hire more workers, and now my Republican colleagues like to point to low unemployment rates as an evidence of success of the 2017 tax bill. However, those numbers don't speak to the quality of these jobs, and in fact, a recent Brookings Institution study found that 53 million Americans, or 44% of those that are 18 to 64-year-old in the workforce, are low-wage workers, meaning they earn a median annual income of just $18,000. I mean, that is a staggering low amount for Americans whose wages has not kept up with the prosperity that has just been afforded to these biggest corporations. So, Professor Furman, can you comment on how cutting the corporate tax rate did or did not benefit workers in the long run?
Right. If you wanted to benefit workers at the bottom, the most immediate step you could take is raising the minimum wage. And in fact, some of the data that we've heard at this hearing in terms of wage growth at the bottom of the income distribution appears to be more related to the many states and cities that have raised their minimum wages in recent years rather than to the tax law. In the medium and long run, the best way to raise wages is to invest in education and training, and it's hard to expand those investments when your tax collections are 16.3% of GDP, the lowest they've been in at least 50 years outside of recessions and their immediate aftermath.
And you have several proposals on how you could have a tax bill where corporations don't scam and just don't find the loopholes. What would be a major provision that would stop them from scamming the system?
Right. Well, I think to actually give an incentive that you only get if you make new investment, as opposed to you get free money regardless of what you do. I think that was at the heart of the difference between what I'm proposing and what was passed in 2017. A lot of the tax cuts in 2017 were just free money for companies based on decisions they made in the past that had nothing to do with creating a better incentive for those companies to invest and grow going forward.
Thank you. I yield back.
Thank the gentlelady. Let me recognize the gentleman from South Carolina, Mr. Rice.
I sit here and listen to the rhetoric, and it really is, it's so depressing to listen to the rhetoric when we should be focusing on ways to make things better instead of trying to convince consumers that the sky is green and that the tax bill is bad and the economy is bad. It's utterly ridiculous. A couple of Gallup polls came out in the last 2 weeks. One says that the confidence in the U.S. economy is the highest since the year 2000, highest since 2000. And a second one said that 90% of Americans are happy in their current situation. 90%. That's an all-time high. Ms. Chi was just talking about how the bill, Tax Reform Act hadn't affected the average worker. Well, unless it's the 10% she's talking about, 90% of Americans are happy in their current situation. That includes 93% of Republicans and 86% of Democrats. And yet we just sit here and throw rhetoric back and forth and try to convince people that the tax bill was bad and that the sky is green and the economy's not good. Wages are rising. Unemployment is at historic lows. I've got 3 of the poorest counties in the state, Marion, Dillon, Marlborough counties. They're majority African-American counties. Every one of them in January of 2017 when President Trump took office, the unemployment rate was between 9.5% to 10%. Every one of them now, the unemployment rate is below 4%. I just Googled a couple of the counties in Ms. Sewell's district, what she referred to as the black border in Alabama. Every one, I Googled Greene and Lowndes counties. Both of them were right at 10. I think one of them was significantly above 10% unemployment. Today, both are below 5% unemployment. And you know, the unemployment rate is kind of like dipping water out of a bucket with a dipper. You know, when you get to the end, it's kind of hard to get the rest of the water out. It gets harder and harder to drop that unemployment rate lower, and I certainly believe that tax reform has had a tremendous effect in lowering that unemployment rate across the demographic groups in the country. When I came here, I had a menu of things I wanted to do because I thought our country simply just wasn't competitive, and what was stifling our growth were things that we put on ourselves and nobody else put on us. And so I had a menu of things created by an economist from Harvard named Michael Porter, who's a worldwide expert on competitive theory, and I know probably every one of you have heard of him. And his menu was 8 items, and I'm going to read all 8 right now very quickly, because we've worked on some and others we hadn't. One is create a sustainable federal budget. We hadn't done anything on that. 2 is immigration of high-skilled individuals, because most countries in the world use their immigration system to make themselves more competitive. President Trump calls it merit-based immigration. We hadn't done anything on that. But it would accelerate our economy, and particularly for people on the low end, because it would stop the flow of people coming here who are willing to work for nothing. 3, simplify the corporate tax code. Check. Create an international tax system. Check. Aggressively use bilateral agreements and improve our international trading and investing system. Partial check. We've made some great progress, but what he said was 80 years ago we were willing to take trade agreements that weren't in our interest to try to lift the rest of the world after World War II, but that was 80 years ago, and we can't afford to do that anymore. And every one of you know that the process of bringing China to the table for these trade agreements has slowed our economy, but every one of you also know it is something that had to be done. Simplify and streamline regulation affecting business. Check. Improve logistical communications and energy infrastructure. Hadn't done that yet, but we need to work on it, and we're all talking about it. And finally, responsible development of our U.S. gas and oil reserves. We have made great progress on 4 of these 8 items, and look at the result. Wages are rising, the economy is growing, the stock market is at all-time highs, record lows in unemployment among every demographic category. What a great success. And all these things are just common sense. And all we need to do is move on to the next ones. Is tax reform exactly what I would have designed? No. Is it working great? Yes. Would it have looked different had you participated and not simply obstructed? Of course. Let's move together collaboratively to improve these things and to move on to these other items that we haven't worked on. Let's help the American people and stop with the ridiculous divisive rhetoric. I yield back.
Thank you. Let me recognize the gentleman from Michigan, Mr. Kildee, to inquire.
Thank you, Mr. Chairman, and thank you to all of the witnesses for being here. It's an important question, an important set of issues, and I'm really happy to hear from all of you. And so rather than continue to dive back into what many of us see as the weaknesses in the Republican Tax Cuts and Jobs Act, I wonder if I could just, Mr. Furman, explore with you a question or two, and then maybe one generally for the panel. When I got here, I was of the view that the corporate tax rate needed to be addressed. We want to be competitive, but we all have different views about what the right landing spot is. And I wonder, Mr. Furman, if you might comment on what would have led the Obama administration to come to the conclusion that, yes, the corporate rate did need to be addressed, but rather than land at 21%, landed at 28%. I mean, what went into that decision? Help us understand the trade-offs.
President Obama actually insisted that we develop a corporate plan that lower the rate. We looked around at rates in other countries. We also looked at the effective rate, not just the rate that's in the statute book. That seemed like a reasonable place to be. Subsequently, the Business Roundtable was asking for a 25% rate and indicated in a number of things that they'd be okay with a higher rate. It is unusual to see a major lobbying group get more than they had asked for out of a piece of legislation, but that does seem to have happened in this case.
I mean, I suppose it could be that those business leaders recognize that the tax rate's important and is a critical variable, but so are the skills of the American workers. And if, as we've seen with the president's proposed budget, the need to reconcile what's happened on revenues with the important investments that we're making leads to us reducing the support that we need to provide to educate workers and prepare them for the skills required to compete in the 21st century, let alone be more productive, it would seem to me that they may have been considering those trade-offs as well.
Yeah. If you didn't consider revenue, you'd set a tax rate of 0. But we need revenue for all sorts of things, including for economic growth. We didn't see a way to write a plan that would lower the rate to 20 or 21% and not lose revenue. I think this committee, when they had originally worked on plans, also had higher tax rates because they also were trying to be revenue neutral and were unable to do it at something like a 21% rate. It was just President Trump saying it didn't need to be revenue neutral that changed that.
It was before I was on the committee, but I remember when Mr. Camp released his plan to a massive thud here in Washington. It did have to, you know, I might not agree with every element of it, but it certainly didn't go so far as to go down to a 20% rate because they didn't feel they could do that and protect the necessary investments that we need to make as a society.
Right, and I believe the Better Way plan had a 25% rate, but I say that with some trepidation around the people who wrote the plan.
If I could just ask the panel to respond too. I mean, one of the concerns that I've had is that some of the investments, the key investments that we make in our development, particularly in the most distressed communities, are organized in the form of tax credit financing, whether it's new market tax credits or the low-income housing tax credit. And it's difficult to not look at what the dynamic effect of a lower tax rate is on the quality and ability to use those tax credit tools to finance development. Any of you have any comment on what we might be looking at as policymakers in order to deal with some of the perhaps unintended consequences related to tax credit financing?
I'm sorry, Congressman, I haven't looked at that, so I don't have an answer for you.
I mean, it does strike me, just talking to people in the field, that it has constrained, in part, the ability to use those tools because the need to use those credits is lesser. And I'm not suggesting that that should cause us to not consider lowering rates, but we have to recognize that there's an impact on those sorts of financing tools when we, on one side of the ledger, deal with the rates, but on the other hand, don't accommodate that with other ways to get at what those tax credit tools are intended to produce. I don't know if anybody has any thoughts on that.
And I think in partial recognition of that, there was some effort to address that in the low-income housing tax credit a little while back as well, and I think that is certainly something to look at.
Okay, I see my time is just about expired. I really appreciate all your time here. Thank you.
Thank the gentleman. Let me recognize the gentleman from Pennsylvania, Mr. Evans, to inquire.
Thank you, thank you, Mr. Chairman. Yesterday, President Trump released his budget for fiscal year 2021. His budget called for cuts to programs that support our nation's most vulnerable. Now, every time we need to get something done in Congress, the first question is, who's going to pay for it? So I want to ask a very simple question to the panel. Who is footing the bill? Who is footing the cost of the bill that we are discussing today? So I want to go down the line and ask you, who's footing the bill? Because somebody has to pay.
The Congressional Budget Office recently put out a report that showed that the bottom 40% of Americans will see effective tax increases as a result of the fiscal policies that were done since the year 2016. So that's the group that's most immediately paying the bill, and more will pay the bill over time.
Yes.
I'd agree with Professor Furman on that point. I'd also look to how we're going to address in future generations the deficits and how we're going to have to deal with that through spending and revenue. And I would hope that we do so in an equitable manner.
So 2 quick answers to that. First, we know who's footing the bill. The corporate tax cuts are the only permanent part of the 2017 tax law, along with 2 measures to pay for it. Cuts to healthcare that hurt many low and moderate income Americans, and a lower rate of inflation that affects every taxpayer across the board. So we know who's paying for those corporate rate cuts that do lose money in the long term. The second thing I would say is that the President's budget also provides a very clear view of who would pay. It includes $1 trillion in making the individual tax cuts permanent, and it also includes $1 trillion of cuts, further cuts to healthcare that it proposes. So again and again, we're seeing that this discussion of the spending problem means cuts to programs, including healthcare, that help most Americans.
I think it's very important to look past the initial impacts and who writes checks and writes smaller checks to government, and look at the impacts on the economy and the benefits that derive from that. And I think that one of the most remarkable things about this era has been the ability of the labor market to generate hundreds of thousands of jobs every month and to draw into work people who had been marginally attached or discouraged entirely. And the wage gains that go to those workers have been disproportionate at the bottom end of the distribution. So I think you have to look at that when you think about who benefited and who did not benefit from this bill.
Can you repeat that last part again? I heard you, but I still think my question was not answered about who's paying for this bill.
I think the people, if you look at the cut in the corporate tax rate, the question is not just what corporation didn't send in as big a check, but who got an economic benefit from that reduction. Did it get shifted on to workers? And my answer would be, in part, yes. That's A, increasingly the answer in the research, and B, that's what we're seeing on the ground. We're seeing people getting jobs who previously were not, and we're seeing the people who get those jobs get the biggest wage gains. And you have to count that as sort of benefit from the bill. That means the cost is borne elsewhere in the economy, whether it's in capital or, my answer, largely on future taxpayers because of the debt.
I'm going to ask Dr. Furman to interpret that for me. Can you help me interpret what he just said to me about who's paying the bill?
Right. So if you look at the direct fiscal change, that is a question that's answered at least on an interim basis in the CBO report, and that's when you have a cost, it's coming from somewhere. They document all the benefit reductions, and they show a 1.4% reduction in the after-tax income as a result of this tax legislation and other fiscal changes. So that's for the bottom quintile, incomes go down because of these. There's then a lot of other things going on, and you can ask whether there's some indirect effect. I would say the biggest other thing going on has been the minimum wage has increased in many states and localities. That obviously is unrelated to anything in this tax law. That's really has helped wages at the bottom.
Thank you, Mr. Chairman. You're back.
Thank the gentleman. Let me recognize the gentleman from Arizona, Mr. Schweikert, to inquire.
Thank you, Mr. Chairman, and this is my moment to annoy everyone. There's a couple of things I do want to walk through. There's been actually some discussions on audits. Let's be careful we don't conflate the term asking for additional information. Someone didn't spell their last name or wasn't readable or those things. That's not an audit. We've actually had a proposal, and I thought I had interest from my brothers and sisters on the left, of some ways to use technology to actually get rid of the two-month delay in earned income tax credit payments going out. The reality of it, in many ways, we're having the wrong discussion about the audit world. Where if you're still thinking it's an army of auditors in today's world where there's so much technology that can mine, you could actually deal with the fraud issue on earned income tax credit, but you could also do some amazing mining up and down the corporate tax revenue side. If our concern there is compliance, and I know I have an expert here, but the fact of the matter is the embracing of technology, capital spends, those things, that information is public, we can mine it. I do want to give a certain level of frustration because when we all get up here and do what all of you have done, and we're doing too, so we're all sinners here, saying, well, revenues should have done this, right? We speak like we're in a vacuum. And I'm sorry, but I'm almost incapable of speaking without charts. But the reality of it, and I'll just throw this one up, just for, when we start talking about revenues in this year compared to that year, it's really interesting, but unless we're also having an understanding of what's happening in the world economy, we're not having an honest conversation of what headwinds, what's really going on. So looks like a GDP growth in 17. Well, the fact of the matter is the rest of the world was doing reasonably well at that moment. This last year, the rest of the world was not doing well. It's not catabis paribus. We're having a dishonest conversation. The other thing I also wish, if we're going to talk about tax policy, we've already had 3 or 4 members come up behind the microphone and say we care a lot about protecting Social Security and Medicare. we also got to deal with the reality that if you're going to say you care about Social Security and Medicare, tax policy has to be how you maximize economic expansion, or we're in incredible trouble. This is from the CBO this year. CBO projects budget deficit rise is entirely Social Security and Medicare over the next decades. Is that Republican or Democrat? It's just demographics. We're getting old. And yet we're unwilling to have this conversation because it's really hard to explain to our voters. But it's the CBO, I mean, it's our neutral auditor. The other thing is, once again, next 30 years, if we strip out Social Security and Medicare, we functionally have $23 trillion in the bank. We put Social Security and Medicare back in, and their accompanying interest. Now, this chart is not inflation adjusted, so remove about a third of it. We go from $23 trillion in the bank to $103 in debt. Every conversation we have about tax policy, demographics, everything else has to be, how do we deal with the fact of the matter the gray tsunami's here? And my fear is this sort of political wedging is incredibly frustrating because we're walking by the tsunami pretending it's not there. Doug, I don't know if you saw, but last week CBO did an update from their August update. I'm sure we all saw this because we all live for the next CBO update. They reduced the 10-year window by $705 billion in debt. About 400 some billion of it was interest. The rest was the fairly healthy growth we're having in payroll taxes. I've been trying to make an argument that repatriation is substantially bigger than we expected. Savings rates are substantially bigger than joint tax actually had modeled. Any comments you can share in regards to just from August to now, we're already seeing 10-year projection differences because of that healthy labor market and savings rates?
I think the most important of the revisions we saw in the January outlook were the interest rate assumptions, which brought down net interest payments by the government substantially. They did, as a result of better economic growth and better wage growth, substantially raise the jumping off points for those tax collections, and I think those are important. I guess my basic reaction, though, is $700-odd billion in a world that has, $15 trillion of deficits over the next 10 years is not a lot to get excited about.
No, but it's a movement. And Mr. Chairman, my last comment is, let's be really careful in some of our conversations where we start talking about corporate taxes and we long for the era where we as politicians got to give out little prizes to those who lobbied us and this and that, instead of trying to create as flat and competitive a model as we possibly can, because none of us are smart enough to know what the next economic breakthrough is. And with that, yield back.
Thank the gentleman. Call upon the gentleman from Illinois, Mr. Schneider, to inquire.
Thank you, Mr. Chairman. I want to thank the witnesses for joining us today and sharing your perspectives. I want to highlight an important section from the National Taxpayers Advocates 2020 Purple Book, and I quote, "The IRS mission statement says the agency's mission is to provide America's taxpayers top quality service by helping them understand and meet their tax responsibilities and enforce the law with integrity and fairness to all. Since fiscal year 2010, the IRS budget has been reduced by more than 20% after adjusting for inflation. Largely as a result of these budget reductions, the IRS is neither providing top quality servicing nor enforcing the law with fairness to all. This should have everybody in this room concerned. So let me repeat one of those lines. The IRS is neither providing top quality service nor enforcing the law with fairness to all." And we can have a debate on whether a specific tax law is fair or not fair, but I suspect that there's a consensus that if a law is not enforced across the board, is not enforced the same for everyone or every group, that's not fair. And I'll open it to the whole panel. Does anyone disagree with that? Okay, so I think we have not consensus, but unanimity. And I think this is really jarring. the agency tasked with enforcing the law with integrity and fairness to all is failing at its core responsibility. IRS staffing is on the decline, as was noted earlier. The agency employed 78,000 people in 2019, nearly 16,000 less people than the employees it had just 10 years ago. The number of operations staff has fallen by 31%, and the number of revenue agents with the expertise to conduct audits of complex returns has fallen by 35%. And the IRS's $11.5 billion budget is $640 million below that of 10 years ago. That just doesn't seem right. Ms. Wong, I'll turn to you briefly for a question. When you have limited resources, you set your priorities, you often go after the low-hanging fruit. You touched on this in your testimony. Where's the low-hanging fruit that the IRS seems to be pursuing?
Well, the IRS should be pursuing those who contribute most to the tax gap. But as you mentioned, the simplest returns are those that get audited, as the colloquial term, but the correspondence exam by mail for low-income filers to send more documentation to substantiate their claims.
All right, so the low-hanging fruit, on one hand, you can say, well, go where it's the easiest to understand. Those are the simple individual returns. But the potential to find those abusing, the people taking advantage of the system, are going to be the more complex. Exactly. And the IRS doesn't have the resources. And I raise this because it's the individuals and groups that follow the law that are footing the bill for those who skirt the rules. I'm particularly concerned with this lack of funding and enforcement is allowing wrongdoers to get away with it within a very narrow area, our tax-exempt system. Last week, I released a report detailing a pattern of misdeeds by the NRA, the National Rifle Association. It details egregious spending by NRA leaders, extensive self-dealing and conflicts of interest, and pervasive efforts to hide their activities and avoid transparency. Last year in this room, I questioned the Treasury Inspector General for tax administration and laid out a series of scenarios similar to the allegations facing the NRA, and the TIGTA confirmed that they were worthy of investigation. I've asked the IRS to investigate these claims and understand that they cannot share any information due to Section 6103. However, I'm concerned that the National Taxpayer Advocate's 2020 report that says the IRS is unable to properly administer our tax laws makes it harder to hold groups like the NRA to account. Ms. Wong, do you believe the IRS has the resources to investigate organizations like the NRA who use the complexity to hide their activities?
Look, I do know that just generally the IRS is increasingly outmatched by large organizations, both because it lacks the resources, as you said, needed to do the audits in the first place, but also when they do the audits, to be able to do them thoroughly and follow through, again, because these organizations can throw massive resources at an audit to stall it, to flood the IRS with irrelevant documents, to stretch out litigation. And the IRS, on the other hand, is left struggling to pull together funds to actually hire people needed to even start or continue an audit.
Right, so we have an asymmetry. We have the organizations like the NRA or other large corporations who have well-paid, highly trained, very sophisticated tax experts, and an IRS who is understaffed, under-resourced, trying to make sure that the law is applied fairly. And we can debate the law, but I don't think there's any debate, as we said, that whatever the laws are, it should apply to all of us, not just those who don't have the resources to avoid them. Thank you. I look forward to working with my colleagues on both sides to help the IRS fulfill its mission, ensure that our tax laws are applied fairly.
Thank the gentleman. Let me recognize the gentleman from New York, Mr. Swazi, to inquire.
Thank you, Mrs. Chairman. Thank you for holding this. Thank you to our witnesses for being here, for the time you've been here, and for your attention and preparation and the work that you've done to come to this point today. So the purpose of our tax code is to raise enough money to fund our governments and to be fair. We want it to be fair to the people that live here. So we're not doing a very good job as far as funding our government. So we hear from everybody here, we've got massive deficits, we're not funding an infrastructure program, we've got major problems with a growing senior population, it's going to affect Medicare, it's going to affect Social Security, we've got climate change problems, we don't have enough auditors to collect enough money from the people that should be paying their fair share. So we're not really doing that great a job funding our government. And as far as fairness goes, that's really my big concern. So we know that the stock market it's up again today. And we know that the stock market's been going up since the 1980s. It's up 1,300% since the 1980s. And we know that the GDP is up 600%, or maybe if it's more than that now, since the 1980s. But wages are not going up. We see more and more of a concentration of wealth with very wealthy people. And we hear some statistics about wages going up for the lowest wage people in the United States of America. Mr. Holtz, you've got a reputation of being an honest broker. The reason the wages are going up for the lowest paid people in America mainly because of increases in the minimum wage?
It's certainly part of it. I actually published a paper yesterday on this, and you can look at the period 2014 to 18. 27 states increased the minimum wage in that period. The remainder did not. In states where the minimum wage went up, you see a much sharper increase in labor earnings at the 10th percentile, the low end. That's that part. But the truth is, it's happening across the board. And
okay, but it's happening much sharper in those places where they increase the minimum wage. That's having the most dramatic impact.
At the lower end.
Competition. Yeah, lower end. I'm talking about lower end right now. Yeah. So we have a declining wage power of people in the middle. And so I'm concerned about the fairness here. We see the stock market going up. 93% of stocks are owned by 10%, the top 10% of wage earners in the United States of America. So the stock market's going up. That's great. Everybody's on TV every night. Oh, the Dow Jones is up today. But how's that affecting everyday people? So a big question about fairness, are corporations paying their fair share? Dr. Furman, you talked in your testimony about corporations in America and the percentage that they pay compared to other countries in the world. Can you just elaborate on that for a second?
Sure. American corporations pay 1.1% of GDP. It's the lowest it's been since the 1930s compared to our own country outside of recessions and their immediate aftermath. It's about 1/3 of the average of other OECD countries, lower than every country except Latvia. I should say there are proposals.
Well, I just want to make that clear. Every OECD country pays a higher percentage of their GDP in corporate taxes than other than Latvia, than the United States.
Correct.
All right, keep on going. You wanted to finish.
Oh, I was going to say, there are proposals that would reduce taxes on corporations and shift them to high-income individuals. This law reduced them on corporations and reduced them on high-income individuals. So there's no attempt to make up for these revenue losses on corporations anywhere else, except for some low and moderate income households explicitly in the law and implicitly through other measures subsequently.
So my big concern about all this stuff is that whatever we do to improve the tax code, whatever we do in government, we have to figure out how can we improve people's wages in the process? How can we have a positive impact on people's lives so that when they're willing to work hard every day, 40 hours a week, 50 weeks a year, take 2 weeks of vacation, they're willing to work hard, they should have a decent life in America. That should be the goal of every conservative, of every liberal in this room. If you're willing to work hard, you should have a decent life in the United States of America. So ways to do that, Dr. Furman suggested earlier, and I agree, raise the minimum wage at the bottom, do a better job with education and training of workers. I believe that we have to do a lot more to support unions and support collective bargaining so that people can fight for fair wages. It was this book I read recently that suggested that if we're going to allow corporations to do stock buybacks, which are a very big part of what happened with these corporate tax cuts, why not require those corporations also to have a profit-sharing program for their employees as part of it as well? What do you think about an idea like that, Dr. Furman?
Congressman, I do think steps like unionization that would change the bargaining power and result in higher compensation for employees are really important. I'm not as sure that I think that I'd like that compensation to be in the form of profit sharing, which has benefits for workers, but also has some risks in concentrating. But I think, broadly speaking, the direction of increasing compensation, increasing bargaining power to get there, I think is central.
Ms. Kaiser, Ms. Wong, Mr. Holtz, what else can we do to increase people's wages in the United States of America? I'm running out of time, so very quickly.
I would encourage you not to get enamored of the minimum wage. The same study I talked to you about shows that it is those people with poor skills and little experience that get hurt by the minimum wage. That's not a group we want to hurt. I think you have to focus on education. We are failing K-12 education in the United States. We've got 1/4 to 1/3 of 4th and 8th graders who are seriously deficient in math and reading, and it's been that way for 10 years. We're condemning them.
Yeah, I'm out of time, Mr. Holtz. I apologize.
I thank the gentleman. Let me
Thank you, Mr.
call upon the gentlelady from Indiana, Ms. Wolarski, to inquire.
Thank you, Mr. Chairman. Thanks to our witnesses as well. We know that before the Tax Cuts and Jobs Act, our tax system was miles behind the rest of the developed world, making American companies less competitive than their other global components around the world, and limiting global investment right here in the United States. This antiquated system has had the real-world impact of preventing American workers and businesses from reaching their full economic potential. Whether it's families struggling to pay for retirement, or trying to save enough to buy a new home, or small businesses unable to hire or expand to hire more workers. I was grateful to be a part of crafting TCJA and modernizing our tax system so American taxpayers can push forward to new economic heights. In fact, recent Federal Reserve data found that Americans have benefited from a 17% increase in household wealth since President Trump's election, and wealth among the bottom half of American taxpayers has increased by 54%. Furthermore, and I think somebody referenced this earlier, a recent Gallup poll revealed that 59% of Americans say they're better off financially than they were a year ago, which is the highest level in the history of Gallup conducting this poll. I think it's abundantly clear that TCJA is working. It's having a profound impact on the Hoosiers that I represent in the state of Indiana. Here's what I see when I travel across the 2nd District in Indiana. Working families are benefiting from the double child tax credit, a historically low unemployment rate, even less than the national average that has reached a 50-year low. Lots of manufacturers in my district, we lead the country in manufacturing, and other businesses in my district are raising wages, increasing tuition reimbursement, awarding bonuses in stock, reinvesting capital, and providing other benefits for their workers. And electrical utilities across my district are lowering their rates. All of this and more is what TCJA is all about. It means more money in the pockets of everyday, hardworking Hoosiers that I represent. This was all accomplished in no small part due to companies of all sizes that chose to invest in American workers as a result of TCJA. I hope we can get together to work on solutions that create jobs and keep this momentum moving, going in Indiana and across the nation. Dr. Holtz-Eakin, what do you believe have been the primary drivers of the economic growth in the last 2 years, and then what do we do to sustain that?
I think the two main things in recent policy have been the regulatory efforts of the administration, which they imposed through executive order and put regulatory budgets on the agencies for the first time and have literally stopped a tsunami of expensive regulations. And the second would be the Tax Cuts and Jobs Act.
What do you see that we as Congress can do to keep that momentum going, say, as we look at the next 2 years, and say, in theory, that we can come up with ways to keep this economic growth going? What's the best thing we can do?
I think permanent tax policy is always better than temporary tax policy. The future of the tax code should get settled and settled as soon as possible. I think it's important to focus that on incentives for economic growth and continue that as the focus of tax policy, because we're going to need that growth, and we're going to have to take on the ever larger federal debt, which is one of the looming risks to economic expansion.
And you know, one of the issues that I think have been so enjoyed and so beneficial in my district with working families is doubling the child tax credit. And I see that every single day as I'm in and out of companies, and every single day when I'm in my district. I'm just curious among the whole panel here. I think there's equal agreement across the board, no matter if you're left or right on this issue, that doubling the child tax credit has definitely made an impact on helping working families benefit from having children and being able to provide them for their children. Is there anybody here that thinks that it's actually worth taking that doubling of the child tax credit out? Or is that something that we absolutely should leave in because data has shown that it's benefiting working families? Does anybody have a comment on that? Go ahead.
Well, I would like to add that
Sure.
I think that these tax credits are very successful and important. I think the problem was that the 26 million children in the lowest income families didn't receive the doubled maximum child tax credit, and 11 million just got $0 to $75.
See, I think it's interesting, and I appreciate your comment, but what I see in a hard-working, blue-collar manufacturing district like mine, I get a lot of input back from constituents talking about the fact of how much it helped them. And I think it's interesting when we talk about paid family leave and the things that we're going to be doing here in the next couple of months, again, to assist working families and trying to get workers back in the workforce. It's a pro-family, it's a pro-worker bill, and I think those kinds of efforts also help as well. But with that, Mr. Chairman, I yield back the balance of my
Thank the gentlelady.
Thank you.
Let me call upon the gentleman from California, Mr. Panetta, to inquire.
Once again, thank you, Mr. Chairman, Ranking Member Brady, and of course the witnesses. Thank you very much for your preparation for being here, and of course all you do to enlighten many of us. So thank you very much. Dr. Furman, going back to your slides that you had, in particular,
what I have here is Figure 2, the tax revenue from OECD countries. I want to ask a historical question and then a historic question. Historically, 2018, you have the U.S. second from the bottom, with Latvia at the bottom. Talk to me before 2017. Where would the U.S. have? Where would it come in? Would it have at least met the advanced OECD average?
We still would have been below the average even before that law.
Okay. Would we ever?
This moved us further from the average.
Would we ever been at that average at any time?
I wouldn't be surprised if a decade ago we were.
Okay. All right. Got it. Now, these types of low revenue numbers, obviously, that has an effect on our deficits and ultimately our debt, correct?
Yes.
And Mr. Holtz-Eakin, you answered a question directly from the chairman. Tax cuts don't pay for themselves, correct?
Correct.
What economic conditions need to occur in order to have those tax cuts pay for themselves?
I don't believe such conditions exist. That's why I said no.
Okay. All right. Is there anything from a deficit perspective? Is there any sort of conditions that could exist that you would think of?
The most feedback you're going to get from a tax cut would be at the depths of a recession, which would allow you to more quickly get back to full employment. Over some short periods there, you might be able to find something that looks closer, but it's not a proposition I generally believe in.
Okay, I appreciate that. And then, Mr. Furman, Dr. Furman, excuse me, are we seeing enough growth right now to mitigate the cost of the 2017 tax bill?
No, in fact, growth has come in below what was expected, and revenue has come in even lower than what was projected after taking into account the cost of the tax cut.
Okay, all right. Now, obviously, when Congress began working on this tax reform, there were a lot of discussions about lowering the rates and broadening the base. Professor Kaiser, you talked about broadening the base, and I think you said something to the effect of you said in regards to the 21% corporate tax rate, it's overly generous, correct?
Correct.
All right. And given the rest of the law, do you have a different, more appropriate number in mind?
I think the 28% figure is more appropriate. You have to look at the system you have to look at the system as a whole, and the fact that tax-exempt investors are escaping taxation. That means that the double tax isn't really a double tax. If we look at the fact that we have currently expensing, which I would actually make permanent, that would allow us to invest in a higher rate because that would be taxing the supernormal returns. I think that the $700 billion of revenue that we would gain from that could be used to invest in things like education and making the world, the country, a better place.
Understood. Dr. Furman, would you agree?
Yes.
Okay. Any other areas that you could think of?
I think on the international side, I certainly agree with a lot of the statements about the international side having been broken prior to this law. President Obama had proposed an international minimum tax. GILTI has some things in common with that and some things that are improvements. Has some things that are badly wrong, though. For example, it applies that tax on a per-country basis rather than, on a worldwide basis rather than a per-country basis, and that allows you to offset taxes and lack of taxes in tax havens with operations in higher tax countries. It can create an incentive to shift your operations overseas and undoes a lot of good that provision would do. So just one simple change, take GILTI and do it on a per-country basis. That would make sure you can't do the shifting to the tax havens that provision was intended to do. You'd want to do many other things as well. That's just one easy, simple step you could take.
Outstanding. We'll leave it at that. Thank you. I'll yield back, Mr. Chairman.
Thank the gentleman. The gentleman from Nevada, Mr. Horsford, is recognized.
Thank you very much, Mr. Chairman, and to the ranking member. As both a member of the Ways and Means and the Budget Committee, I'm grateful to have the vantage point to see how both spending and revenue priorities align in this body, in the Senate, and the proposals coming from the White House. While some of my colleagues focus on information from certain economic indexes related to the economy, measuring success largely by stock markets and how the rich, very rich are doing, for example, I think that there are other more important measures that indicate whether our economy is strong or not. I would argue that it's time for us to start to value the measurements that matter to those in the middle class and the working poor. As some of you may be aware, a recent report by the Brookings Institute reported that 53 million full-time, year-round workers, which represent 44% of our entire workforce in this country, earn barely enough to live within a median annual income of $18,000. Simultaneously, 28 million Americans are working part-time jobs, and 57 million Americans are working in the gig economy. Roughly 2/3 of Americans making $30,000 annually would say that they are one emergency away from financial ruin. This is particularly true when it comes to a health emergency. And when we talk about racial disparities in unemployment, the black rate of unemployment is at 6%, double that of white unemployment, and the Hispanic rate is over 4.3%. So instead of making the law's tax cuts work for the middle class, small businesses and entrepreneurs, who really are the engines of our economy, the Congress in 2017 chose to prioritize the very rich and big corporations, passing the largest single corporate tax cut in history. And what happened as a result? A national deficit which increased to $1 trillion more a year, and it's expected to grow to $1.9 trillion by 2029. And lo and behold, here we are 3 years later, and the gig is up. We knew that the tax cuts for big corporations would be on the backs of the middle class and working poor. So the president released in his budget yesterday cuts that would be devastating to the middle class. $4.6 trillion cut over a decade for safety net programs, $900 million in cuts to Medicaid, $500 billion in cuts to Medicare, $182 billion in cuts to SNAP, $63 billion in cuts to Social Security, the disability insurance program. So my colleagues say all the time that we have a spending problem. Is Social Security, are the people on Social Security a problem? Are the people who rely on Medicaid, children and seniors, a problem? Are our commitments to beneficiaries on Medicare a problem? I don't think so. On top of that, this budget by the president increases funding to the IRS, which we have heard will negatively impact the working poor who are selected for audit nearly 40% of the time, while the largest corporations are audited far less. This demonstrates the tax inequity for the wealthy and big corporations. Recently, we heard about the fact that of the 91 Fortune 500 companies identified by ITEP, they paid little to no federal income tax in 2018. Yet, in 2018, the IRS conducted 16,000 audits on corporations, but nearly 400,000 audits on EITC recipients. So, Ms. Wong, I'd like to ask you, is this an equitable treatment of the poor as it pertains to tax fairness and the audits of EIT recipients over big corporations and the very wealthy?
It's disproportionate to who actually files returns with error and who doesn't comply with their taxes. The focus really should be on where the dollars are not being paid, and that's at the top and large corporations. And the IRS will need funding to do that. I think Congress and the IRS can consider a variety of measures to make sure that that money doesn't just flow to more audits for low-income people, but in fact goes to where it's needed, which is auditing and compliance among those high net worth filers and large corporations.
Thank you, Mr. Chairman.
I thank the gentleman. Let me recognize the gentleman from Ohio, Dr. Westrup.
Thank you, Mr. Chairman. And I want to thank Mr. Horsford for talking about the budget and serving on the Budget Committee, because I do look forward to the budget coming out of the House of Representatives, because the president can only do what Congress sends him, and that's the only thing he can sign into law. So I look forward to your budget, Mr. Horsford. And also, we've had some talk about the stock market. You know, I'm not a huge historian, but I do know what happened when the stock market crashed. And it seems to me we are better as a nation when we have a thriving stock market, and we can talk about some of the concerns of who's getting rich and who's not. But to say that having a strong stock market is a problem is wrong. And there was some talk before, too, about new market and historic tax credits. I can tell you in Cincinnati, Ohio, the most dangerous area, one of the worst areas in America as far as drugs and violence and crime, is now a thriving go-to destination due to the benefits of new market and historic tax credits. Well, look, we live in a different world since World War II. It's a global economy today, and we have to compete, and we cannot ignore competition from around the world. When we we get burned. You know, a little bit of history. JFK, John Kennedy, President Kennedy, said he ran on getting America moving again. He said a rising tide lifts all boats, and that strong economic growth would not continue without lowering taxes. Where have we gotten to in this debate today? You know, corporations aren't just empty buildings. They're filled with employees. They're filled with people that go home to their families with a roof over their head and could put a meal on the table. Now, we can debate some of the things like, you know, how they handle their tax break, but this is the reality, and I've seen more in my district where corporations and businesses expanded and hired more people because of the tax break. But these are talking points. Condemn a corporation, and I guess you condemn all those people that work there. And is it that, or are you just against who's in the White House, so everything's bad? You know, we have to, you know, set priorities. You know, if your priority is that you want a government that needs more rather than asking this government to be more efficient and lean, go ahead. If you'd rather do that than improve the lives of all Americans, go ahead, because what does success look like for you? You know, I know in the last administration we talked about we have more people insured than ever before. Well, let me just use that as an example. That was more people going on Medicaid. I'm a doctor. Medicaid has the highest mortality and morbidity than any plan in America. And I want that safety net there. I want all of our safety nets there. But our safety nets are weakened. We do better when fewer people need the safety net. Because you know what that does? That actually makes the safety net more available to the most vulnerable people. And that's what we're seeing. So CMS said Medicaid and CHIP participation has gone down by 2.4 million from December of 17 to June of 19. Did that save us money? It did. And why? Because more people are working and they have employee-sponsored health care. This helps the most vulnerable. I can tell you as a doctor, when I started in practice, if I saw a couple Medicaid patients a month, no big deal. I don't care if I don't even get paid. But when the numbers start going up, as little as it pays, and the administrative hassle, you have to decide how many Medicaid patients you can see if you're going to keep your doors open. That's a reality, folks. This is a good thing that's taking place. When you talk about the cost, Dr. Furman, did you include that in dynamic scoring, what we're saving by fewer people needing to be on Medicaid today? Probably not. You can answer me.
Yes.
That savings incorporated?
Yes, it looks at the relationship between GDP and that spending historically, and that includes...
Well, I don't think specifically that savings is included in that, but this is what I'm talking about. You know, we are going in a good direction. If we want to tweak some things, fine. But let's quit acting like the world is coming to an end when a lot of people are benefiting and doing much better. With that, I yield back.
Thank the gentleman. Let me recognize the gentleman from New York, Mr. Higgins.
Thank you, Mr. Chairman. And I would agree that, you know, history is very important here. The United States economy has been growing for a record 129 consecutive months. That's nearly 11 years. In the final months of the George W. Bush presidency, the economy had collapsed. The economy for 6 months straight was losing 712,000 jobs per month. President Obama inherited the worst economy in 80 years. He fixed it by advancing policies that, in the short term, staved off what would have been a deeper and longer recession, but set the economy on a trajectory for record growth. President Obama's was adding, the last 36 months of his presidency, he was adding 224,000 jobs each month. So President Trump really got a good economy from his predecessor, where President Obama kind of got stiffed from his. For the past 36 months, the Trump presidency, the economy has added 182 jobs each month, which is 42,000 jobs fewer than when compared to President Obama's the last 3 years. The 2017 Tax Cut and Jobs Act created, a deficit situation whereby when President Trump took over before the Tax Cut and Jobs Act, there was a $600 billion deficit. Now there's a $1 trillion deficit. The Trump presidency has added $3 trillion to the national debt. The United States manufacturing economy is in recession, and but the expansion continues primarily because of the American consumer, which is 70% of the entire American economy. Dr. Furman, you were chair of the White House Council of Economic Advisors. Your successors, particularly within the context of the 2017 Tax Cut and Jobs Act, issued a report basically saying that because of the Jobs Act of 2017, every American household would receive between $4,000 and $9,000 increase in their household income on an annual basis. Your thoughts about that?
Yeah, the research that was cited in that report, most of the researchers came out and said their research had been misused and used in an erroneous manner in coming up with that number. Economists at conservative organizations like the American Enterprise Institute and the Tax Foundation found much, much smaller numbers than that. I've done my own analysis with Robert Barrow, one of my colleagues in the economics department at Harvard, and we found effectively a minuscule effect on wages from the law. And when you take everything into account, the impact on after-tax wages, once all of it's paid for, could very well be negative.
As the former chair of the White House Council of Economic Advisors, what is the traditional purpose of issuing a report like that? Is it to advise the president?
Right. I mean, I'm very proud. If you look at the reports we did, very often the numbers we had were right in the middle of the range of CBO. For example, on stimulus, CBO said, I can't remember the numbers, it might be from 1 to 3. Right. Our number was 2. We were always well within the range. I would have found it very uncomfortable to be in a place making projections that were completely at variance with places like CBO, JCT, the Treasury, and the like. This report by the Council of Economic Advisors was greatly at variance with the economics profession, with the professionals that do this, and appeared to be designed to aid the passage of the law, not inform the public or the administration.
So as to advance deliberately erroneous information toward the goal of bamboozling people?
I don't know if it was deliberately erroneous, sloppy by people who didn't care about the sloppiness, but whatever it was, the research it relied on was disavowed the report.
How many economists are typically on a White House Council of Economic Advisors?
There's about 25 economists there and other staff as well.
So it'd be hard for them just to make a mistake.
I don't know how the report was written. All I can tell you is it was highly inaccurate and highly at variance with every other analysis from left to right.
Thank you very much.
Thank the gentleman. The gentlelady from Florida, Ms. Murphy, is recognized.
Thank you, Mr. Chairman, and thank you to the witnesses for your testimonies. I co-chair the Blue Dog Coalition. We're a group of moderate Democrats who prioritize bipartisan cooperation, a strong national defense, and fiscal responsibility. And it may sound quaint or old-fashioned, but our coalition believes excessive debts and deficits pose a threat to our economy, our security, and our children's future. We believe that as lawmakers, we have to make a good faith effort to get our fiscal house in order by bringing government revenues and expenditures into better alignment. And in times of economic stability and low unemployment, we should be trying to make our fiscal problem better. And at a minimum, we should be trying not to make it any worse. And as Mr. Furman and Larry Summers wrote in a recent essay, when you're in a hole, one logical approach is to stop digging. Consistent with this do no harm philosophy, Blue Dogs have generally insisted that any new legislative measure that would increase the deficit should be paid for with spending cuts or revenue raisers. If something truly is worth doing, then it should be worth paying for. And trust me, putting this philosophy into practice doesn't always make us really popular with our colleagues. And it requires us at times to cast some tough votes, which I would submit is what we're elected to do. As Blue Dogs, we try to be equal opportunity critics. We call out those members of our party who argue that deficits and debts don't matter, and who suggest that we can make fiscal policy without any semblance of fiscal restraint. And if those deficit dismissers are, if what they're saying sounds too good to be true, it's because it is. And at the same time, Blue Dogs don't hesitate to condemn Republican hypocrisy on this subject. You know, the GOP skillfully talks the talk on fiscal responsibility, but rarely walks the walk when they're in power. And the TCJA is arguably the most egregious example of the gap between Republican rhetoric and Republican action. I opposed this bill because it was unprincipled, hyper-partisan, and sloppy. But above all, I opposed it because it was clear it would make our deficit and debt problem worse. 2 years out, the evidence has confirmed our fears. CBO just released its latest budget outlook, and the numbers show the fiscal state of our union is neither strong nor sound. Inadequate revenue collection, caused in part by the TCJA, is a major culprit. And last fiscal year, the federal budget deficit was $984 billion and is expected to exceed $1 trillion this year and every year for the next decade. Over the same period, federal debt held by the public is projected to rise from 78% to nearly 100% of GDP, which would be unprecedented in our history. To manage the economic and security risks associated with large and rising deficits and debts, we need to take a thoughtful and bipartisan approach on both the spending and the revenue side of the ledger. And the taxation of business income needs to be a part of this debate. Ms. Wong, I'd like you to put yourself in my position for a moment. My fellow Blue Dogs and I spend a lot of time trying to convince House Democratic leaders that we, as a party, need to take fiscal responsibility and things like pay-as-you-go seriously. And by and large, they're receptive. They realize this matters, especially to future generations. At the same time, though, they do sometimes question why we, as Democrats, should take the hard steps required to get our fiscal house in order when it was the Republicans, with their undeserved public reputation for fiscal responsibility, who blew a gigantic hole in our budget with the TCJA. Can you comment on how passage of the budget-busting tax law has made it so much harder going forward to reach bipartisan compromise when it comes to managing deficits and debt?
I think there was a recognition both before and after the 2017 tax law was passed that because of its addition to deficits and debt, primarily for tax cuts for the wealthy and corporations, that it is a threat to future standards of living for most ordinary Americans who rely on things like Social Security, healthcare, and investments across a range of things that actually help strengthen the economy. So I think that is one important reason where there is a sort of a wide recognition of the threat that it poses. I'd also just plop in a plug there for a bipartisan measure that is fiscally responsible, which would be IRS enforcement funding, which is one of the very few things that pays for itself very many times over from collecting taxes that are already owed under law.
Thank you, Ms. Dr. Furman, I'm probably more of a budget hawk than you are, but you're not someone who dismisses the need for some budgetary discipline. Can you tell me what the practical consequences would be if our country continues to add to the debt and deficit?
Yeah, I certainly don't think we should be on the debt and deficit track we're on now. And not digging the hole any deeper, as you said, through PAYGO, I think would be an important thing to keep us from making that worse. Not extending the parts of this tax cut without paying for them when they expire. Paying for Social Security and Medicare, I would do that on the revenue side. But if you took all of those types of steps, it would put us on a much more sustainable course than we're on now.
Thank you, and I yield back.
Thank the gentlelady. Gentleman from Texas, Mr. Arrington, is recognized.
Thank you, Mr. Chairman. Thank you, witnesses. And wow, I think there are certainly parallel universes when we have these hearings, it seems to me, because it seems that the facts are indisputable. And for all the world to see with respect to how this economy is performing, Dr. Furman, I heard your analogy about the caveman, and I think we'll use that because, as Geico said, this should be so simple even a caveman can figure it out. So the caveman goes in 3 years ago probably because he's depressed, because of high unemployment, the lack of job opportunity. He comes out 3 years later and he finds that there are more jobs than there are actually people who are unemployed. Is that a fact, that there are more jobs, about 1 million or more, than there are people unemployed? Dr. Furman, is that a fact? Is it a fact, yes or no?
Yes.
Okay, so that wasn't the case when that caveman went into the cave because of his depression over the lack of opportunity. And now we have this fertile land of opportunity teeming with all sorts of jobs, manufacturing confidence, consumer confidence, and, by the way, so simple a caveman can figure it out, wages are up, decade high, and they're up more at the lower end. They're up more for the worker than the manager. Fact or not, Dr. Furman? Is that a fact? The wages are up at a 10-year high. Yes or no?
Wages almost every year for the last 60 years.
So
have
wages
been at
are
an
just
all-time
always
high.
up.
Every year for the last 60 years, they hit an all-time high.
So wages are just always going to go up every year. We can expect that.
Not every year, but most years.
So would you say it's that wages are up and that they're up at the lower end and that the worker's actually doing better than the manager and the supervisor? The caveman would be pleased with that. Would you agree? Let's be honest. The caveman is happier all of a sudden. He's happier, by the way, like the 90% of Americans who took the Gallup poll, the highest they've ever seen in terms of satisfaction. 84% of Democrats said they were satisfied. Over half of the Democrats in this country said they're very satisfied. 63% of the American people said this president's doing a great job on the economy. And the list goes on. 75%, the caveman would discern pretty quickly, 75% of the American people think the future looks better and brighter. 75%. So, and then if he talks to some of his African-American friends and finds out that the unemployment is at an all-time low for African-Americans, and his Hispanic colleagues, he'd find out that it was record low. We've broken records in terms of moving people to work and opportunity and a more hopeful future. He'd find out that millions of Americans, his fellow Americans, who may had to struggle with the depression of the economic outlook before he went into the cave, are now moving off of welfare by the droves. And they're moving out of the trap of government dependency into self-sufficiency and opportunity. Isn't that what we want for our fellow Americans? I think the caveman would be pretty happy, Dr. Holtz-Eakin, don't you think?
I presume so.
Well, are you happier today about this economy?
Yes, I am.
Do you think the tax cuts, the regulatory relief, the fair trade, the new access to markets and customers for farmers, for manufacturers, do you think that these economic policies that the American people say at 63% are good? Do you think they are creating this economic boom, this comeback, as the president called it?
As I said before, I think that it's been a plus, the regulatory and tax policies. I'm pleased to see USMCA signed into law going forward. I would give the China trade war less than a passing grade.
Yeah, well, in spite of the fallout from the tariffs and the uncertainty in the trade, I mean, you've got to take that in consideration. Nobody's wanted to deal with that until this president came along. A lot of folks talked about it, but nobody wanted to take it head on because of the fallout. There was going to need to be some pain before the ultimate future gain, and this president did it. And I think the best is yet to come as a result of that component. Would you agree?
I hope so. I mean, having served in 2 previous administrations, you have to say things we tried didn't work.
Mr. Chairman, I yield back.
Thank the gentleman. The gentlelady from Milwaukee is recognized to inquire.
Thank you so much, Mr. Chairman, and I want to thank all the witnesses for their appearance here. I'm last, so that must mean that I'm the cleanup lady here. I just want to know, Mr. Holtz-Eakin, you said in your testimony, your written testimony, that it was too soon to say whether the Tax Cuts and Jobs Act, and some of our members have said that we haven't seen the receipts yet, and so it's too early to tell what the impact of the Tax Cuts and Jobs Act has finally on whether or not our economy is improving. Do you abide by that answer?
Yeah, as a matter of science, the central need was to improve the trend rate of growth in the United States, which is far too low, and we don't know the answer to that yet.
Okay, thank you. I'm 68 years old, and I kind of remember back in 1980, 81, when I was a much younger person, hearing about trickle down. So I've been kind of waiting on that to work. So even if we can't determine whether or not the Tax Cuts or Jobs Act, the presumption was that if we gave tax cuts to businesses, according to your testimony, that they'd have the opportunity to invest. Did that happen, Dr. Furman?
No, it did not.
No, it did not.
And,
okay, go on. No, I don't have a lot of time. It did not happen. We have also, supposedly, our GDP was supposed to increase, and it's creeping along at about 2.1%, certainly not the 4 or 6% we predicted. As a matter of fact, historically speaking, Dr. Furman, is there a relationship, positive relationship, between GDP growth and tax cuts?
There's not a clear relationship.
Okay, very good. We have talked about the low unemployment rate, and it just grates me to hear about the low unemployment rate for African Americans. I've got my best friend is 71 years old, and she has 3 jobs, so she's got 3 of those jobs that we keep talking about. We have heard from several of the witnesses that wages have only gone up in those states, and Dr. Holtz-Eakin, you even stipulated to this, in those states where those municipalities or states have increased the minimum wage. Do you still agree
For the record, that is not what I said.
Okay.
They went up everywhere. They went up more rapidly at the 10th percentile in those states that raised the minimum wage.
Okay, but that's a significant part in any wage increase phenomenon we're seeing. Would you agree with that?
No.
No? How about you, Dr. Furman?
I think it's been a major factor in why wages have grown
fine.
at the bottom.
Mr. Holtz-Eakin, you told Mrs. Walorski that our regulatory policy would be a good way to continue to go. But do you agree that the deficits, and my colleague, Ms. Murphy, is very concerned about deficits, would you agree that the regulatory policy goes outside of the reconciliation, our reconciliation process, and it really increases the deficits, and that's why we've seen CBO score?
I may have misspoken, but the regulatory costs I'm concerned about are those imposed on the private sector by federal
But what I'm
regulation.
saying is that the regulatory rules changes have given businesses, corporations, even more money than the Tax Cuts and Jobs Act. Do you know what I'm talking about, Dr. Furman?
You've seen disproportionate gains from the corporate tax.
And it's gone outside of those budget projections. And so that the deficits, which are so harmful to our economy, are increasing because of the abuses that are being committed as a result of that. My time is waning, so I definitely want to ask Professor Kaiser a question about her testimony. The regulatory benefits. Can you just close out here with how the deficits have ballooned with this regulatory abuse?
Sure. So the Congressional Budget Office included a revision of $110 billion of reduced corporate tax receipts, and they attributed this revision in part due to regulations announced by the IRS. They don't provide further information on which of the international regulations might be contributing to this downward adjustment in revenue. I discuss in my testimony areas where the Treasury regulations have been really overly generous to corporations.
Thank you so much for that. And just last but not least, the stock market crash in 1939, I wasn't around, but it came because we had the greatest income inequality in history, and we're back there now. And so thank you, and Mr. Chairman, I would yield back.
Thank the gentlelady. Gentleman from Virginia, Mr. Byer, is recognized.
Thank you, Mr. Chairman. Thank you all very much for being here. I'd like just point out to my friend Dr. Wenstrup, who questioned the strength of Medicaid because of its high morbidity and high mortality, that may also logically be connected to the fact that you're then serving the people that have the worst nutrition, the lowest education, the most stress, the least exercise. Dr. Furman, you were put in the position by my friend, Mr. Arrington, to have a lot of yes and no answers. Do you want to take a couple of minutes to give more nuanced answers to his questions?
Sure, thank you so much for that, and maybe you're interested too. Almost every year for the last 100 years, the U.S. economy was larger than it was the last year. The unemployment rate goes up rapidly in recessions, and outside of recessions every year it comes down. Wages grow almost every year. So the economy is bigger today than it was in 2016. The unemployment rate is lower than it was. Wages are higher than they were. None of that is particularly surprising. When the tax cut was passed, the prediction wasn't that the economy would continue to grow, it's that it would grow at a faster rate. In particular, the prediction that was widely made was that the growth rate would jump up to 3% a year. Instead, we've seen the growth rate stay about the same as what it was before the tax cut passed. And from that alone, that goes greatly at variance with what was predicted for the tax cut, greatly at variance with the standard for the assessment of it. I then want to, with some trepidation, return to the cavemen we were discussing. The issue is not, does the person emerge from the cave and ask, is GDP larger than it was 2 years ago, unemployment rate lower than 2 years ago? That's not surprising at all. It's why did that happen? And this hearing has acted as if the only thing that's happened in the U.S. economy in the last several years is the tax changes, maybe occasionally a reference to a trade war. An even bigger factor for the macroeconomy has been the extraordinary monetary policy stimulus that we've seen. Very, very unusually, the Federal Reserve is acting like they're trying to forestall a recession rather than tamp down a boom. And so long-term rates are now 1.8 percentage points below where they're expected to be. In terms of fiscal policy, we saw tax cuts, but we also saw the bipartisan budget acts of 2018 and 2019. Those were an extensive fiscal stimulus. And so, yes, we have actually gotten extra growth from that fiscal stimulus, more from the spending increases than from the tax cuts. And then we've had a trade war, which I think has gone in the opposite direction in terms of economic growth. But all in, the most important factors adding to our growth in recent years have been the Federal Reserve and the spending increases. The tax cuts have been tertiary, and the tax cuts are totally unsurprising. The economy continues to grow. What's very surprising, for at least the cheerleaders for the tax cuts should be surprising, is that that growth rate hasn't increased, hasn't come anywhere close to the 3% that was promised. I think, sorry, I should have been answering you.
That's okay. We've heard about record levels of revenue, which I think is pretty disingenuous since we were at 16.3% of GDP last year. They may be highest in total dollars, but as a percentage of our government, especially when you look at these $1 trillion deficits for many years to come, there's clearly a need for more revenue to responsibly fund our government. And it should come from both the corporate and the individual side. I can't tell you how many corporate CEOs told me, yes, we need the corporate tax cuts to be competitive internationally, but I can personally pay more. Dr. Furman, when you talk about revenue-raising changes to the corporate side, do you also see a need on the individual side? And by the way, Senator Van Hollen and I have introduced the millionaire surtax, which is 10% on all income over $1 million, as a partial but elegant solution to this.
Yeah, I was just sticking to the topic of the hearing, but strongly think we need to do it on the individual side, and a millionaire surcharge, I think, would be a perfectly good, simple provision. I think we could do bigger things to reform the tax code, but I think that would be perfectly fine and make the world a better place if that was all we did.
And probably have no impact on the standard of living of those people that it touched. So.
I don't know that they would notice very much of a difference in what economists call utility.
Ms. Swang, I only have a very short question, but you know, the Section 199 Cap A, the tax law is passed through entities. And I've been leading the family pass-through entities for many years, so it did help. But would you consider the Trump Organization a small business, or Robert Mercer's Renaissance Technology, or Hobby Lobby, or was there anything in the tax bill that took this small business provision and made it really for small businesses?
You're right, 60% of that tax cut went to the top 1%, and those are the sorts of businesses that it overwhelmingly benefited.
Thank you, Mr. Chairman. I yield back.
Thank the gentleman. Let me recognize a gentleman from Kansas, Mr. Estes, to inquire.
Thank you, Mr. Chairman, and thank you to all of our witnesses for joining us today. Appreciate you taking the time to be involved with us. I know we've had a lot of conflicting things that have been said as we've gone through this hearing, but it's undeniable that we're experiencing strong growth in our economy. You know, since the Tax Cuts and Jobs Act were passed in 2017, hardworking Americans are now enjoying the lowest unemployment rate in decades, and in some cases in recorded history of unemployment, and well-deserved wage growth. I might argue a little bit of some of the comments about whether we've seen wage growth every year. If you look back since the 90s up until a few years ago, median income was stagnant at around the $35,000, $36,000 a year level for family income. What we're seeing that grow. We're seeing that the actual percentage of people that are working has increased as well, which had been declining. You know, last year in my district in Kansas, middle-class families got over a $2,100 increase in average per family in the growth in their income. So not only, when you talk about the Tax Cuts and Jobs Act, it's been a success for families and for workers, and it's allowed our businesses to thrive in the global economy. We all know that tax structure and tax policy affect decisions, both for companies as well as for individuals. And our old antiquated tax code really punished companies that were based in the United States because we had the highest effective tax rate. And what it did was it drove them to actually move their operations overseas, at least compared to what other G7 countries are. Because the Tax Cuts and Jobs Act helped level the playing field, countries are starting to move production back in the United States and bringing more jobs back to Kansas and the rest of the country. When corporations choose to stay in the United States and leave their money and their taxes here, they do invest in new technology, new infrastructure, as well as hiring more Americans. I've seen that in Wichita, Kansas, which is the center of my district. We're known as the air capital of the world. We're seeing a lot more manufacturing, particularly in aerospace, as well as some of the other manufacturing areas there. So we're seeing the benefits of that. You know, since 2017, there's 35,000 new jobs added in Kansas. And so workers are seeing, in addition to seeing a job themselves, seeing higher wages as well as bonuses that were paid. I did have a couple questions. I mean, Mr. Holtz-Eakin, you know, in addition to our very high corporate tax rate, there were other parts of our tax code that were harming our competitive position prior to the Tax Cuts and Jobs Act. Of course, the United States had a worldwide tax system with deferral. And how do you compare our prior tax code with our competitors and how that impacted us?
We were badly out of line with our developed world competitors. We were the only country left with a worldwide system. We had seen others with worldwide systems on basically an annual basis. Some OECD country would flip over to a more territorial system. None are pure, but they were all moving in the same direction. We were the last to get on that train. The rate, of course, was the highest, and certainly 21% was a dramatic change in the rate, but it got us to the middle of the pack, and the pack's still moving south. So, you know, after the '86 reform, we had the lowest corporate rate in the world. We got around to the next tax reform, we had the highest one. So I think it's worth keeping an eye on where our competitive position is at every point.
Thank you on that. And one of the other things, too, I think there was some discussion earlier, and maybe some confusion in terms of what was being said about working-class Americans and whether the tax reform really overlooked them. Is there anything you want to add to your statements around that to clarify what might have been some confusion around how they're benefiting?
The central challenge at the time of the act was to improve growth in the U.S. economy, to give those working people a better chance at the American dream. The standard of living used to double every 35 years. It was on track to double every 75 years. And people felt their access to the American dream disappearing over the horizon. I wanted policies that would change that. And we don't tax corporations. People pay taxes, but how we collect those taxes matters. And our corporate code was hurting American workers in a very dramatic fashion.
Yeah, which is an interesting statistic about it would only double every 75 years under the old tax code. So I appreciate that comment. So thank you. With that, I yield back, Mr. Chairman.
Thank the gentleman. Let me recognize the gentleman from California, Mr. Gomez, to inquire.
Thank you, Mr. Chairman. I just got on this committee this year, and it is a great committee. But it's days like this where I look at my colleagues on the other side of the aisle, I'll try to figure out, what are they talking about? Because it seems so devoid of the reality that most Americans are in. You know, I remember, I wasn't even on this committee when we started talking about the Republican tax cuts. Let's call them what they are, the Republican tax cuts that were passed by this president. You own them, you pass them, you own them, and all the negative consequences that come along with it, right? So I met with some experts, and I asked them just to get ready to find out about this tax proposal, what it was going to do. And since the 80s, I've been informed that not one single tax cut has paid for themselves. And this is something that, as all of you know, I don't have to explain it to you, you're experts, right? That it continuously occurs. They say every time, they always say, the Republicans, we're going to cut taxes, and then we're going to have amazing growth, and then the new revenues are going to offset the tax cut, so we're not going to have to cut services. But then, lo and behold, just like it happened just yesterday with the president's new budget proposal, we have cuts to programs, right? It is now all of a sudden we have, what is it, $900 billion from Medicaid over the next 2 years, $200 billion from SNAP, $179 billion from public service loan forgiveness. It's all connected. It has this ripple effect, right? But, you know, we get on TV and the camera and we just want our little snippet so we can cut it and put it on, you know, Instagram, social media, so we can send it to our constituents or our stakeholders and say, listen, I'm fighting for you. But then it misses the bigger point, is that it's all connected. Tax policy and giving these tax cuts without a real responsible kind of reality check is going to have negative consequences on future generations. So, good example, Mr. Furman, you're bringing up that Treasury is implementing a tax cut like we're in a recession, more or less. What happens when we get into a real recession? You know, what's going to happen to the deficit? What's going to happen to, like, what options are we going to have?
Yeah, I think I think economically, actually, we will have enough room to do fiscal stimulus. I'm worried politically, though, that people will look at the deficit and be afraid to do what the economy needs, and as a result, we would suffer.
Yeah. We don't really know when the next recession is going to come forward, but we have to, like, I know we're always beyond the 7-year cycle. I'm not sure we're on a 10-year cycle now. One of the things I also want to know is there any way to roll this back in a responsible way, you know, when it comes to raising revenue and then at the same time being prepared for the next recession?
Yeah, I mean, I outlined in my testimony one approach to doing that. On the international side, I think things like reforming GILTI would be important to that. I think Congress could also, unrelated to corporate taxes, and I think this could be a real bipartisan issue, improve the automatic stabilizers. You said you don't know when the next recession is. No one knows when the next recession is, and having it so that you automatically get tax cuts or spending increases that happen when that recession happens, I think is something that is bipartisan good government.
Is there any other components within the tax system that we should reform, just across the board? Like I'm a co-author of the 99.8% tax, reinstituting the estate tax. That's something that I'm looking at. Ms. Wang, you're shaking your head. Just
I think one of the key problems that we're seeing when you put together the corporate side with the individual side at the moment is that large amounts of income from wealth, whether it's business wealth or personal wealth, can accumulate across years and not get taxed year to year, and even be passed down across generations and face no or little tax. So that's one of the key areas to go to for raising these revenues that we need to address the fiscal situation. And I think the estate tax is a really good example of doing that.
Ms. Kaiser, you agree with that?
I think capital income in general is too lightly taxed, and I think we need to think seriously about reforms to address that, including mark-to-market.
Well, my time is up, and I hope we do get up to a point where we can have an honest discussion regarding our fiscal health as a country. And it's not just a blue dog or a Republican, but I'm a progressive Democrat. I know that what's needed is a strong fiscal house in order to prevent cuts in social programs that I care about, that my constituents care about. Mr. Chairman, with that, I yield back.
Thank the gentleman. I would also like to thank our witnesses for joining us today. Please be advised that members have 2 weeks to submit written questions to be answered later in writing. Those questions and your answers will be made part of the formal hearing record. With that, the Ways and Means Committee stands adjourned. Thanks, Kevin. Get ready for tomorrow.